Good morning, everyone. Welcome to Yahoo Finance Live. I'm Brad Smith alongside Diane King Hall. Let's get right to the three things that you need to know this morning. First thing you need to know, JPMorgan announced this morning that they have acquired First Republic Bank after the regional bank's failure. The deal will see JPMorgan acquire a majority of First Republic's assets. The FDIC estimating the deal comes at a $13 billion cost to the Deposit Insurance Fund. Now, First Republic is the second largest bank failure in U.S. history and the third major institution to fail in 2 months. This is the latest acquisition for JPMorgan, already the U.S.'s largest bank, which has snapped up more than 30 companies since 2021. Second thing you need to know, the 2023 Milken Conference is underway this morning. Global leaders have descended on Beverly Hills for 4 days of presentations and parties. And the theme of advancing a thriving world comes amid tightening financial conditions, fears of a recession, and geopolitical tensions. Yahoo Finance's executive editor, Brian Sazi, is on the ground in California, bringing us the latest from the conference. And third thing that you need to know, it's another big week for earnings. Ford is reporting on Tuesday. Investors, they're going to get a closer look under the hood as the company accelerates EV investment and production, but expects to lose $3 billion in its electric vehicle business during 2023. Plus, all eyes are on Apple on Thursday. The tech giant looks to navigate challenges in a persistently weak PC market as production shifts away from China as well, and in what's been a strong first quarter for tech earnings. We'll be watching them. Also reporting this week, Peloton, Coinbase, Starbucks, and Uber, just to name a few.
Now, to start the day, we are taking a trip down memory lane and tracking the series of unfortunate events leading to the collapse of First Republic Bank. This now clocks in as the second largest bank failure, a spot previously held by Silicon Valley Bank at the time of its collapse earlier this year. With more on the events leading up to JPMorgan Chase's takeover of First Republic after its demise, we have Yahoo Finance's Brad Smith, who will have the details on this. Yeah. Really, I mean, we could see this coming, but now, but take us through the timeline. Yeah,
exactly. So regulators, they seized First Republic Bank, marking it the third failure of a U.S. bank since March, which is the month where this story begins. First Republic began its fight for survival following the failures of Silicon Valley Bank and Signature Bank, and in its wake, panic about the stability of regional lenders cascaded across the country. Shares of First Republic nosedived 62% as it tried to weather the turmoil by borrowing from the Federal Reserve and the Federal Home Loan Bank, all while also taking in $30 billion in uninsured deposits from the 11 largest banks in the country. However, more turbulence shook the banking sector after Credit Suisse found itself in hot water, eventually leading to the Swiss bank being taken over by rival UBS in hopes to avoid more market-shaking turmoil. Fast forward to earnings season. Investors got a peek behind the curtain at the extent of the impact from the banking stresses in March. And while big banks came out fairly unscathed as JPMorgan racked in a major first quarter profit, First Republic, on the other hand, found itself in a world of pain. Shares of the bank, they sank, hitting a low after the embattled lender reported its quarterly results, revealing total deposits fell nearly 41% during the first quarter. In the coming days, the struggling lender found itself looking for aid once again from big banks, but this time to no avail. Not longer after the Fed and the FDIC's introspective reports on bank failures in March came the addition of First Republic's bank failure here. So now, with JPMorgan taking in First Republic under its wing, the bank has just become even bigger here. And even, Diane, as we think about what this means going forward from here, right. You were listening into one of the media calls this morning. We've been able to get a glimpse of what JPMorgan's vision is going to be like, even as they are continuing to signal to the street what their intentions are, even within this consolidation.
So they said, obviously, this is going to take some time. There were some things they can't answer right now. They said, obviously, their investor day is coming up. So there will be some more questions answered as the days ahead. They reiterated some things that we know, that they said that they were, obviously, they didn't seek out this. Right. They were asked to come to the table on this deal. So, not completely surprised there, but there was a question asked about just issues with regard to other regional banks, and do we see more stress there? Jamie Dimon said that didn't see the same issues that we've seen with SVB, with Signature Bank, et cetera. So he talked about just really shoring up. Someone talked about this and if there are any parallels with regard to the financial crisis, sure. 2008-09. He said this is different than that time period. Yeah, and we've continued to kind of glean back to that at length as well. And it's fair to remember here as well that First Republic was actually a spinoff of, back then, I believe it was Merrill. Yep. And so they're kind of coming full circle here and
with
think
another
about
major
how
consolidation.
in terms of just the relationship with these financial institutions, Merrill folded into B of A. B of A was asked to come to the table with regard to this deal, with JPM getting the majority of the assets of First Republic Bank.
Absolutely. We've got much more discussion on this with a wider look at what First Republic's failure means for the banking industry at large. We're joined by David Chiaverini, who is the Wedbush Securities Managing Director of Equity Research. David, great to have you here with us once again. First, as we think about what this implies for confidence in the banking sector, does the confidence improve after this to the general public, businesses that are dealing with banks, depositors that have also, in one way or another, had to think across, all right, where are they depositing? Where is their money sitting right now? Is the confidence amid this banking crisis, is it more secure or less so after a deal like this?
Yeah, I think that the resolution of First Republic should be helpful because this was sort of the last of the big banks that was teetering. So I would think that with this behind the industry, it should lead to additional kind of confidence that everything is kind of the acute stress in the system is behind us, at least in the here and now. Now, there are headwinds facing the banking industry as we look out over the next 12 to 18 months. But at least in the very near term, I'm not expecting any additional bank failures. There are a couple, smaller banks that have some issues in terms of their fair value accounting. But in terms of bigger banks where the media has really latched onto, and these smaller banks just aren't getting the same level of attention, which means we probably won't see bank runs on those smaller banks. But when you have a big bank like First Republic that is teetering, and a lot of people know the name First Republic, it makes it susceptible to a potential bank run. And that's what we saw in the first quarter in the aftermath of SVB and Signature Bank going down.
David, Diane here. Got to ask you, could or should the federal government have done more to shore up the regional banking sector?
I think they did exactly what they needed to do, and the stresses on First Republic were just insurmountable, even with the unprecedented liquidity. Because remember, the Federal Reserve put in place the Bank Term Funding Program right after SVB went down. And that enabled banks to pledge their securities at par value, even though they were actually worth much less than the par value. So from a regulator standpoint, they did what they could to stabilize the system. And unfortunately, it wasn't enough for First Republic.
Is this it? Is the banking crisis over?
I think the acute banking crisis is over from an interest rate risk perspective because of that Bank Term Funding Program. That stress on securities portfolios is what kind of ignited the downfall of SVB and Signature Bank and now First Republic. That BTFP program should enable the stability to be in place. But as we look out, what I was alluding to with the 12 to 18 month outlook, the Fed is out there with quantitative tightening. They're raising interest rates. They're looking to slow down the economy. Unemployment may increase, and that could make returning funds or repaying loans that much more difficult. So credit quality could begin to weaken, particularly within commercial real estate and the office market. And that could be the next shoe to drop with the banking system, but I'm not expecting that to really come to fruition until 12 to 18 months from now. So from an acute standpoint, I think it's behind us.
Okay, so from an acute standpoint, you're seeing that the issues in the regional banking sector behind us. But talk to me about the deal landscape. Obviously, this wasn't a deal. I mean, this was receivership, then JPM buying the majority of the assets. So what are you expecting to see with regard to consolidation in the banking sector? Are you expecting to see more, the bigger banks gobbling up the regional banks, or is there a place do the regional banks continue to have their place in the business system?
I do expect some additional consolidation, and we've seen consolidation occurring over the past several decades, and I think that an event like this could accelerate it. Now, right now, the bid-ask spread between buyer expectations and seller expectations is pretty wide. So I would think that any deals that occur very well may be in a somewhat distressed scenario as this credit quality issue, moves forward. But I do expect additional consolidation to occur.
And so with what's taking place across the banking sector to this point, there was a question in the previous Fed meeting of whether or not that would change any type of policy pathway that they had set forth on. So now in the next FOMC meeting that is set to commence, how does this change at least the discussion that they've been having?
I think that they've been steadfast in their approach of trying to bring down inflation to that 2% target, and they've communicated that they are nearing the end of their rate hiking cycle. So we're expecting another 25 basis point rate hike. There could be one more after that, but all signs are kind of pointing to them pausing after the next 1 to 2 rate hikes. And the futures market is actually looking towards potentially seeing rate cuts either at the late part of this year or early 2024. So I think that they're not going to kind of waver from the path that they've been on, despite First Republic going to JPMorgan this morning.
All right. Well, from First Republic to the Fed, our thanks to David Chiaverini of Wedbush Securities, Managing Director, Equity Research. Thanks so much. All right. Let's shift our focus now to the Golden State as the annual Milken Institute Global Conference is underway in Beverly Hills, with a new wrinkle added to the banking sector stress after First Republic's collapse. We're checking with Yahoo Finance's Brian Sazi on what he's picking up on from the halls of the Beverly Hilton. Sazi?
Yeah, Diane, good to see you here. Well, this conference certainly got a lot more interesting than it already was going to be. 3,500 people at this conference, 280 sessions. And as those folks come in, stream into the Beverly Hilton here in California, they are awaking to news. Of course, as you've been talking about all morning long, JPMorgan now owning First Republic. And I thought this conference call by Jamie Dimon and his CFO, Jeffrey Barnum, this morning was absolutely remarkable. You had Jamie Dimon saying this, which I think says so much about where JPMorgan and how important that company continues to be in financial services. Jamie Dimon saying this, quote, "I was just the first call." He continues to be the first call anytime there is a banking crisis in this country. Jamie Dimon gets that first call, and he gets what a lot of people are telling me this morning, a sweetheart deal on First Republic. JPMorgan, of course, Jamie Dimon was out there, Washington Mutual during the past financial crisis, getting what looks to be a very good deal on First Republic here. Top of mind amongst a lot of folks that we were going to talk to at this conference. One of the key interviews right out of the chute for us today is Citigroup CEO Jane Fraser, who was part of that banking consortium that invested $5 billion into First Republic back in March. My understanding is they get that money back. So from a Citigroup perspective, that is a good thing. But what does it mean to their business as a Jamie Dimon and JPMorgan get stronger here today in the wealth management business, where Citigroup and many other players are trying to get even stronger? I will just add this, going back to that conference call from Jamie Dimon, he's saying that the financial system is stable, and he is urging folks to take a deep breath. Again, a remarkable conversation, and we'll have a lot more remarkable conversations here at the Milken Conference throughout today. I encourage everyone to tune in and bring their notebook.
Brian, while we've got you, in those remarkable conversations, where do you expect that a different R word might come up, and that is recession?
Well, Brett, I think recession is top of mind. There are actually some folks on Wall Street that I have talked to thinking we already are in a mild economic contraction here in the second quarter. Of course, recession is seen as 2 quarters in a row of negative growth. But again, we have to put that recession question to every person we interview here because the economy has slowed down in large part of what we've seen from the Federal Reserve. And let's keep in mind the Federal Reserve is going to come out this week, likely raise rates another 25 basis points. And there is no indication that despite the economic slowdown, they are poised to pull back on rate hikes as the year goes along. A lot of folks that I have been talking to recently are putting on a lot of trades under the assumption that in the back half of the year, the Fed is still out here raising rates, but in 25 basis point increments.
Well, lots to come from the Milken Institute conference, what they call Davos West. Sazi, keeping a close eye on that. And be sure to keep an eye on Yahoo Finance's coverage of the conference, where we will be bringing you conversations with names like Apollo CEO Mark Rowan, Citi CEO Jane Fraser, and, of course, Michael Milken.
Well, we are entering the busiest week for earnings season with 162 companies in the S&P 500 on deck to report. We're waiting to hear results from Apple, Ford, and Starbucks, just to name a few. Oh, yeah, there we've got all those logos for you populated Monday through Friday. Those reports should offer a closer look on consumer spending in the economy that is slowing. Our next guest saying that he's unimpressed with what we've seen so far this season and things might get a little worse. Joining us now with his take is Howard Silverblatt, S&P Dow Jones Indices Senior Index Analyst. Unimpressed, Howard? Okay, what would it take for you to be impressed?
Not unimpressed, but we've beaten the 77% of the issues have beaten the estimates, but the estimates were lowered over the last 6 weeks. So if you measure them against where they were 6 weeks ago, we had a slight miss. But bottom line is that we do have decent numbers. It's not an earnings recession. The cash flow seems good. We have about 64% of the dollar values in so far. And so the numbers are good, but they're nothing to write home again. Going forward, the guidance looks a little bit shaky at this point. The high assumption and optimism that the Fed will stop at the 0.25, consumers will start spending again, and built into the second half here is that companies will again be able to push through all their cost increases, plus maybe a little bit more to increase the profits, with the second half expected to be 12% up. That's a bit optimistic at this point, and we are paying for that on high PEs. So it's not that earnings are doing bad, but they're not doing as good as the majority of the street right now is pricing in.
So, Howard, I got to ask you, you said not an earnings recession. You brought up the R word. So what is your prediction? Does it remain the same about when we would potentially or could potentially see a recession?
Well, I think we've already seen and are in a selective recession, depending upon your economic group as well as the sector that you're in. Going forward, I do see more pressure on consumers. They are being more selective. They're reducing the costs, and costs are still going up, slowly, but going up, especially in materials. And we're seeing some variances in energy and transportation costs on there, which are very volatile. Energy, by the way, is one of the standouts for this quarter. They're contributing about 9.6% of the earnings. They only make up 4.6%. So they're doing a good job there. But as far as the earnings going forward, again, the optimism for the second half is very high. And I think the profit numbers are much too high at this point, showing an 11% margin. Historically, we're dealing about 8.3%. So again, optimism is very high. And if for some reason the Fed continues on past the 25 basis points, or consumers continue to be cautious and selective on their earnings, those numbers are going to be reflected in the earnings for the second half. And we're going to have to redo the PEs.
So it's largely been, if I can summarize it correctly, according to your perspective, it's been relief that we've seen even some of the rallies, post-earnings beats that were, of course, on some of the lowered expectations. So is there still resiliency that you're seeing in some of the companies right now, especially within tech, which we've seen become extremely just volatile or gap up one way or the other after earnings? They've been highly reactive. So what would that signal to you? What does that set up for a company like Apple that reports this week?
Yeah, tech definitely has been very profitable on that, representing about 18-19% of the index earnings. Financials, by the way, 20% at this point in time. we haven't had as many reserves or losses on there. But definitely the companies are able to push through on products consumers want. Again, I used that word selective recession before, but a lot of the consumer products out there that tech is associated with add to the day-to-day convenience and enjoyment of people, and they are spending on that and pulling back in other areas. So again, technology does seem like they're very profitable. The cash flow is good going forward. They're expected to do well into the second half, not just the second quarter, but the second half as well. Not the higher numbers that we're seeing overall for optimism, but more sustained numbers, double-digit gain for next quarter. So again, they seem to have decent product placement and the ability, the elasticity to increase their prices along and consumers are spending on it.
Howard, in your last postmortem, your previous one, you noted the facts about SVB and Signature being out of the picture. At the time, First Republic was still in the picture. Given what has just occurred overnight from Sunday to today with regard to First Republic, is there any cause for concern about cracks in the banking sector from your view?
Well, not at this point from this morning. It is a concern, especially on a dividend scale, because we expect lower growth in the financials and therefore dividend growth would be less. However, the JPMorgan's up this morning. If you see it near a 52-week high, should open up around there. Additionally, we're not seeing the expansion into other regionals out there. Again, additional regulations will be there. Profit margins for the sector, especially the regionals, will be lower. So it's concern, but not the wholesale bank failures that we're seeing at this point. It does seem to be contained. I would not be surprised to see other regionals get into some issues, shall we say, maybe have an arranged marriage over a weekend. But again, these three are three different kind of situations on here. And so far, the financial markets have controlled it. Whether long-term it's going to be beneficial or not, we'll have to see. But short-term, we've definitely controlled the damage.
Also, this earnings season, Howard, we're going to be watching for, of course, this week, Ford and Starbucks. On one side, you've got the little luxuries for consumers, and on the other side, you have a very financed purchase. Of course, sometimes I do finance my coffee cup, depending upon which one I'm getting at Starbucks. But at the end of the day, financing a vehicle, far more important in the day in, day out for a lot of people. So what will we gauge about the consumer by the end of this week that we haven't already known this earnings season?
Which areas consumers are spending? Are they going for the day-to-day? As you said, that Starbucks coffee is a little bit more than the wagon, the trucks on the street, to see if that's impacting it at all. So we'll get a better feeling of where they're pulling back. I mentioned the technology, so a lot of the groups there that consumers are spending. So we need to see, are they moving down into lower retail areas? Are they, what they're pulling back on? We'll need not just this week, but another couple of weeks as the retailers come out with their diagnostics and their reporting on there. But it's definitely consumer time to figure out what they have. We saw the institutions, we saw the banks, which are very important. Some of the ITs, more this week, but the social media ones as well as the retails are going to tell us what the individual, which is the bulk of the spending, where it's going and hopefully where we expect it to go.
Howard Silverblatt, S&P Dow Jones Indices Senior Index Analyst. Howard, thanks for taking up the time and teeing up this week in earnings for us. We appreciate it.
Thank you.
Absolutely. Coming up, everyone, SoFi shares are getting a boost today on the back of its earnings report. We're going to highlight the top headlines from that next. Welcome back, everyone. You're watching Yahoo Finance Live. Let's take a look at some of today's market movers, starting with SoFi Technologies, the online lender, topping estimates in its latest quarter as it still expects this year to be profitable. Take a look at shares here, pre-market up by about 6%. A few things noteworthy here on the member and product growth side of the business. They said that they achieved strong year-over-year growth in both members and products in the first quarter. Member additions, new ones, of about 433,000. That brought their total member figure to nearly 5.7 million by the end of the quarter. So that's up by about 46% from the end of 2022's first quarter there.
Yeah. I mean, SoFi in focus. We've got a few names in focus. This after, as you mentioned, their better than expected results. Also, we know that they're pursuing the Biden administration, suing the Biden administration about that potential pause of student loans. They don't want that repayment pause to happen, or they don't want that, they want their money, basically.
Right, yeah. And I mean, across their segments here too, where they're trying to maintain the profitability and continue to see that revenue come in. Financial services segment, worth noting, total products increased by about 51% year over year there to 7.1 million during the first quarter here. And ultimately, inclusive of the checking and savings and cash management accounts, SoFi Money grew 48% year over year there. So that particularly interesting there. And the platform saying that they had enabled accounts increased by 15% year over year, all in that figure coming out at 126.3 million there. So we'll hear what more the company has to say about this quarter.
And predicting they'll be profitable by the end of the year, as you highlighted. So overall better than expected. I wonder if that account for predicting profitability has to do with the student loans.
And it's a huge part of where in the lending segment for SoFi. And as we talk about financial conditions right now, SoFi, one of the more kind of new lenders that had come out on the street and really had a more digital and led a more digital transformation of the lending practices there. Particularly, they noted that in this quarter, their net revenues came in at about $337.1 million in that lending segment there. And the contribution margin for that increased to 65% from 54% in the same prior year period. So seeing more profitability there. But again, really continued focus on what that lending business is doing, especially within this environment more broadly as financial conditions tighten a little bit more.
But that stock definitely expected to pop at the open. So
yeah, we saw shares here pre-market trading higher by about 6% here. Speaking of pre-market, we're taking a look at the major averages. We've got those futures for you in the bottom right-hand corner of your screen. You've been seeing those scroll through. We are looking flat to the downside by about 0.1% for the NASDAQ, the Dow right now flat, about as it gets to the downside, and the S&P 500 also looking flat as we get closer to the opening bell.
I mean, I think investors trying to read the tea leaves on the First Republic situation with JPMorgan Chase acquiring the majority of the assets there, trying to decide are there still problems in the banking sector. We've heard Jamie Dimon sound off saying basically it's been contained. Analysts that we speak to say they don't see further stress in that respect, though there may be consolidation in general. And we are just, again, seconds away from the opening bell on Wall Street. The opening bell sounding off, kicking off a new week, not just a new week, but a new month, new money on Wall Street. Let's get right over to Brad, who's going to be at the Yahoo Finance Interactive and taking us through what's ahead.
Yeah, we saw the opening bell there. Quinnipiac ringing the opening bell at the New York Stock Exchange. Shout out to the university. I had a cousin, actually two of them, that played basketball there. So shout out to Quinnipiac. Anyway, taking a look at the major averages here out of the gate right now. The Dow Jones Industrial Average, you're seeing that higher right now by about 0.1%. Let's give you some context on this. Didn't mean to go over to the heat map that early, but we'll get back to that in a hot second here. Let's give you some context on the move that we're seeing here out of the gate and just populate this over the past 5 days for you. Taking a look at the Dow, past 5 days, still net higher, fractionally by about 0.8%. So here out of the gate, adding on to that just a little bit. The NASDAQ composite, you're seeing that flat just barely to the downside by about 0.1% here, 14 points in the red to start things off. Past 5 days, though, it's been good. Think back to some of the earnings reports that we got last week. And so ultimately, we're going to get even more of those components that report over the course of this week as well. Past 5 days up by about 1.5% here today. A little bit of a blip out of the gate. But about the S&P 500? You're seeing that over the past 5 days as well. That higher by about 0.8%. We'll see if we can hold on to those gains as we move through some more of those earnings reports. About 170-ish companies, I believe it was, that are reporting out of the S&P 500 this week. So we're going to be watching that closely to see what kind of movements take place there. Overall, though, top line flat, just barely to the downside, though, to start off today's trading activity. And as we always do, let's take a look at those 11 S&P 500 sectors to kick off. Hey, it's May. Oh, my goodness. New trading month, new trading week, and new trading day. Who dis? All right, taking a look at XLE. We are down by 1.4%. Way to steal the thunder there, XLE. XLF, though, on some big news in the financial services landscape this morning. You're seeing XLF up by about 0.2%. Overall, we're relatively split here, about as split as you could get for 11 sectors. And then we'll just ride out with a look at the NASDAQ 100 so you can get a glimpse at some of those mega cap tech stocks to start your Monday.
Good stuff. All right. Shifting gears to the auto space as GM gets an upgrade from Morgan Stanley. The firm boosting the stock to overweight from equal weight, noting, quote, GM may be over earning, but the stock is oversold. So that's an interesting one. We know that they posted their earnings last week. The stock up 2% this morning off the back of that upgrade. 2 shares. I mean, one of the things that was interesting to note when they posted their quarterly report last week is them killing off the Bolt, which was,
bye-bye,
yes,
Bolt.
I know, RIP. But basically, it's just cutting the cord and in their way, kind of going just all in on EV, saying basically they're going to retool. And I guess the reason that they needed to do that has to do with just getting their production capacity in order for their fuller push into EV. So that was interesting. And people were surprised by that, about them killing off the Bolt because it's such a good performer, but they're planning to retool existing plants to get ready for their larger push with regard to EV, Brad.
Yeah, the Bolt was really just an unsexy EV play, and Tesla came along and made electric vehicles sexy. That's great for them, but it's the way that they came into the market, really looking at that higher tier. Now, what's going to be key as well is where other auto manufacturers, and we're going to hear from Ford over the course of this week too, it's going to be interesting to see on the pricing war that has ensued. In Tesla's case, might be hitting itself in the foot in one way or the other. It's all about where for the other automakers who have been able to go to their dealership capacities, who have been able to go to the client bases that they already have because they're able to say, oh yeah, just trade in, trade up. We've already got you in the ecosystem, in the family of products. You already own one of the GM Hummers perhaps. Why don't you just get a new Hummer? We've got it electrified for you. There's a little bit of a wait list, but that's all right. So for GM, I think, bringing it back to what Morgan Stanley is thinking, they think investors are looking past these shares here and particularly saying that they're over earning, but the stock is oversold here. So ultimately, continuing to look at GM within the context of what we'll hear from Ford, which is now a business that will have 3 divisions that they're reporting for when they do report earnings. In this EV landscape, still early moments of this year, still only 6% of the auto sales here. And so for some of the legacy automakers that we're hearing from over the course of this earnings season, how they're spending to ramp up a lot of that spend is going to be key to keep a close eye on too.
Yeah, indeed. I mean, it's got me thinking, do I need to get into the EV game myself?
I got to get a car first. We're going to start there. On Semi,
right.
We've been tracking them this morning too, out with a beat on the top and bottom line here, followed by a better than expected earnings forecast here. That MTA pass works just well.
It does.
Yeah, still works, still swipes, and I can tap to pay now. Anyway, taking a look at On Semiconductor, you're seeing shares up by about 4.25% right now. A few of the things to note from this most recent quarter here that really jumped out to me. Number one, the company, they saw revenue of about $1.95 billion. That is an increase of about 1% year over year. They also mentioned here that automotive revenue grew 38% year over year. That's a record 50% of their total revenue.
I mean, it just goes to what we were just talking about with regard to vehicles. Vehicles rely more on chips, not just, EVs. Like nowadays, if you're buying a newer vehicle, there's going to be more technology involved with it. So the semiconductor space benefits from that, hence on being on today, So not surprised that there's some strength there with regard to that. And we just saw a pickup in the auto sector. It started during the pandemic and it just continues with regard to that sector. in the auto sector being the beneficiary of that. I'm sure we'll see more, we'll have more insight when Ford reports this week as well.
Yeah, I'm not going to act like a scientist or a chemist with this one, but if there are any investors that are looking at there's a term that you might hear, or at least a compound that you might hear a little bit more about. That's as scientific as I get.
Okay.
Going forward from here, they said that they're accelerating their silicon carbide manufacturing output, exceeding some of their internal plans right now and enabling them to nearly double their silicon carbide revenue quarter over quarter there. So silicon carbide.
I'm not a scientist either. I'm like, I don't know.
We leave that to them. That's why we're here. We get to talk about it day in, day out.
We'll just talk about the stock.
Exactly. Coming up, how investors are viewing the state of the economy and the global financial stability in the wake of First Republic's takeover. We'll speak with an economist from BMO coming up next.
It is a busy Monday on Wall Street. JPMorgan Chase officially won the bidding to acquire the majority of First Republic in an emergency government-led intervention. First Republic now ranking as the second largest U.S. bank failure in history. This is coming ahead of an extremely busy week with a crucial Fed meeting, jobs report at the end of the week, and another 157 earnings reports on deck. For more on what to expect, we have Jennifer Lee, BMO senior economist, joining us now. So Jennifer, let's get right into it. What are you expecting in the week ahead?
A lot of activity. Good morning to both of you. And definitely the highlight will, of course, be the Fed meeting, how dovish or how hawkish they're going to sound, what signals they're going to be sending, especially during the press conference will be highly anticipated, I think, followed, of course, by the jobs report.
And so for the news that, of course, has permeated from Sunday evening into Monday morning, as it should, considering the magnitude of what just took place in not just the receivership, but then the ultimate sale of First Republic Bank or parts of it to JPMorgan. Does that change the Fed's conversation at all from your perspective?
I don't think it will, because if it was the very first bank, then perhaps it would. But it showed that the Fed, during the last when SVB went under, they had their meeting in the midst of that crisis, and they sort of kept their heads cool, and they focused on the ultimate goal, which is keeping inflation or bringing inflation down. And I don't think that this is going to change it much. It just shows that this whole crisis, all this banking turmoil, is not over yet, and we're going to have to see how this plays out in terms of financial market reaction, of course, and of course credit availability from the banking sector as a whole.
So, Jennifer, let's widen it back out a little bit. What's your view on the current state of the U.S. economy, and are there any indicators that give you cause for concern?
So right now, I found it kind of interesting that, for example, last week with the U.S. First quarter GDP figure of 1.1%, definitely below expected. But I feel like we're always pushing out that start of that recession. At one point last year, everyone thought that it was going to be kicking in 2022, and now we're moving it into, or we have moved it into the second half or the midpoint of 2023, and that hasn't changed our goal or our view at all. Certainly, all indications are pointing to that slowdown. It's already happening. I haven't seen a lot of indications pointing to a very hard landing just yet, but things are slowly slowing, which is totally as expected after almost 500 basis points of rate hikes. So you have to believe that this is going to happen. And whether or not it's going to be a hard landing or a soft landing is a different question. And we're still looking for a mild contraction for the entire year.
Does that slowdown and kind of the rate by which it is happening, from what you were mentioning a moment ago, does that then prolong the type of recession that we do see?
In many ways, it does. I mean, I think overall it shows the resilience of the U.S. economy. Again, any other economy would have, I don't want to say collapsed, but it would have been hurt a lot more, showing a lot more blood, I guess, at this point after so many rate hikes. But the fact that the U.S. economy continues to grow, the U.S. consumer remains very resilient. Again, slowing down the pace of spending, which is completely to be expected. But the fact that they are still, putting a little bit of money aside for a rainy day, jobs are still very strong, I think speaks to overall resilience of the U.S. economy. So this is why we're sticking with our base case scenario of a mild contraction in the second and third quarters of the year before things start to pick up and improve a little bit in Q4. So we're looking for about 1% growth for all of 2023.
Okay. And then is your base case still no rate cuts until 2024?
That is exactly our base case scenario. I think rate cuts would be way too soon. Why give up all of this hard work of bringing inflation down to current levels of about 2-year lows right now for the headline? Why give that up so quickly starting with rate cuts? So we still see this. We expect this Wednesday's announcement to be the last in terms of rate hikes. So just bringing the Fed funds rate up to just over 5%, but still keeping rates at that, or keeping policy at that those restricted levels. And then we don't see rate cuts being part of the narrative until early 2024.
And okay, so early 2024 for a lot of execs that are just trying to wrap their head around the environment, the macroeconomic environment that they've continued to cite over the course of earnings season after earnings season for what feels like almost a year now. That uncertainty still lies ahead. And so what is the reality of what the business environment looks like, given that they're going to be really mired by this uncertainty for the foreseeable future?
This uncertainty, obviously it's a difficult job, clearly, but at least they are still dealing with, again, resilience. They're still seeing demand. Demand has slowed, which again is completely as expected. So there's still a lot of demand within the U.S. borders. There's still demand coming from overseas, but it's just slowing. So just being able to meet all the new orders, even though they are also slowing. Job growth remains quite robust still. So at least you have to make sure that your labor force is as present and accountable and filling up all those job openings that you still have on your payrolls. So I think facing that, but again, facing slower growth as an environment of higher rates, but at the same time, you have to recognize that inflation is also coming down, which is helping matters, I think, a lot for all parties involved. So that is certainly the positive news of all this, again, after almost 500 basis points of rate hikes.
Jennifer Lee, BMO senior economist. Jennifer, always a pleasure to grab some of your time and get your insights and perspective. Thanks so much.
Thank you.
Coming up, everyone, why our next guest is expecting a long and moderate recession ahead. We'll discuss that next.
Bank failures in March marked the first latent effect from the Fed's aggressive tightening cycle, according to commentary from ClearBridge Investments. The asset management firm now notes that broader risks may materialize later this year, teeing up a recession that's longer and more moderate than expected as tighter lending standards reduce credit availability, weighing on GDP growth. For more on these risks and how you can protect your portfolio, let's get to Jeff Schulte, ClearBridge Investments Chief Investment Officer. Jeff, let's get right into it. What are your first thoughts?
Well, I think the First Republic news this morning is a win-win-win, right? It's obviously accretive to JPMorgan's bottom line. It's the best case scenario for First Republic employees, and it limits the loss for the FDIC. So obviously, I think this clears up the one last bit of uncertainty from the banking crisis in March. But the thing that's going to continue to weigh on economic activity as you look out on the horizon, even if this is a little bit more idiosyncratic than systematic, is tighter lending standards. Now, we're going to get a senior Fed loan survey next week, which will tell us to the degree of which tighter lending standards have happened. But ultimately, I think this weighs on the credit availability in the economy. And it's important to note that lending standards were already at recessionary levels prior to those banking issues. So this is just going to complicate the issue a little bit further.
Is it at all a concern that it once again was JPMorgan that was making the acquisition here, and it wasn't a smaller or a regional bank that was taking on the assets here from First Republic, a bank like PNC, for instance?
Yeah, I think this was the natural suitor for this situation. Very strong balance sheet, well capitalized, able to take this and not really blink an eye. But again, I think a lot of the tightening in lending standards isn't going to be at your larger banks. It's going to be at your smaller banks, obviously banks outside of the top 25 in assets. But more importantly, these banks have very strong relationships with small businesses. And small businesses are starting to feel the impact on profitability from higher interest expenses, and they're not having the ability to pass through higher price increases, and their compensation structures are relatively sticky. So profitability is being hit from a number of different ways with small businesses, and I think it's only a matter of time before you see the layoff cycle broaden from larger companies to Main Street America. And I think the rubber hits the road in the third quarter when that ultimately materializes.
So, Jeff, you see the tightening happening with regard, or the potential for more tightening happening with regard to smaller banks. What's the ripple effect from there? What's the consequence of that?
Well, again, if you look at this particular cycle, a lot of the strength that you have seen were from small businesses. A way to kind of glean out this information is to look at job openings. Prior to the pandemic, there were 7 million job openings. Today, we sit at about 10 million. So there's 3 million excess job openings. When you look at who those excess job openings belong to, about 94% of them are small businesses or businesses with less than 250 employees. And these same businesses make up about 45% of the employment picture in the U.S. So a lot of the resilience that you've seen from the labor market, the inflation, the hotter wage growth are coming from small businesses. And again, if you're going to see tighter lending standards and an assault on profitability for small businesses, that's going to cause a recession. And again, I think that materializes in the second half of the year.
Where are we to first see then those wage adjustments, though? And I guess if we do get to that point where, yeah, small businesses, they're seeing a hit on profitability, cannot sustain the same type of wages that large enterprises might. So where might that start to show up?
Well, it hasn't shown up quite yet. If you look at the employment cost index data that we got on Friday, it shows that wages have peaked, but they're plateauing at a very elevated level. Rhymes with what you're seeing from the Atlanta Fed's wage tracker. So this is an issue. This obviously keeps the Fed in a more hawkish, higher for longer mode. But ultimately, I think the Fed being higher for longer with this wage dynamic is what ultimately causes a deeper recession than what consensus is anticipating. So while most people think it'll be a 1 or 2 on a scale of 10 type of recession, we're thinking because of this delayed reaction function from the Fed and the stickiness that you're seeing with wage growth, we think it's probably going to be a 4 or 5 when all is said and done.
Jeff, you mentioned the jobs numbers that you've seen, that we've all seen, and the data points have been strong there. We have a big jobs report coming at the end of this week. If the job market continues to show strength, are the odds of a recession pushed further out? Is the potential for a recession pushed past 2023?
Well, yeah, the more resilience that you have in the labor market, obviously that's going to push the recession from the third quarter, which is our anticipation, maybe into the fourth quarter of 2024. But I think also more importantly, if you have a stronger labor market, you have stickier wage growth, stickier inflation, that invites the Fed to continue to hike past what they view as terminal, which is one more rate hike from here. So yes, if you see that dynamic, it certainly could push it out a little bit further. But one of the reasons why I think it won't be a 2024 type of recession is because if you look at the leading economic indicator index by the Conference Board, you've seen 12 consecutive monthly declines. The only two times that you've seen more consecutive monthly declines was 1973 and 2007. Maybe looking at that from a different vantage point, the LEIs are down 7.8% on a year-over-year basis. The largest drop that you've ever seen with the LEIs ahead of a recession was 5.7% back in 1980. So no matter how you cut this, even if you do have a more resilient labor market, I think a recession is on the horizon, and I don't necessarily see it bleeding to 2024.
May the Conference Board be your guide. I think we just came up with a new tagline for them. We'll get some commission on that somehow, Jeff. Jeff Schulze, who is the ClearBridge Investment CIO. Jeff, thanks for taking the time this morning.
Thank you.
Definitely. Coming up, we're going to head back to the Milken Conference where our very own Brian Sozzi has two big interviews. You don't want to miss it. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Diane King-Hall. Julie Hyman has the day off. We're taking a look at some trending tickers this morning. Should come as no surprise. We've got JPM as the top trending ticker here on the Yahoo Finance platform. Right now up by about 2.6%. And then you're also seeing some of the other companies that we've been tracking throughout the morning. SoFi, that was on earnings. It's actually now down by about 5.5% here. And then additionally, we ran through On Semiconductor earlier. Just want to give you a view of where the rest of the financial services sector and the banks here. We'll go big banks first, and then we'll go a little regional action for you here. JPM, as we mentioned, that's up 2.6%. Bank of America, you're seeing that up by only by about 0.3% here on the day, as JPM really getting a steal of a deal there after the receivership by the FDIC for the assets of First Republic Bank here. We're also taking a look at some of the other larger banks just to see how they're moving. Some of them in concert, some of them not so much. You're seeing Morgan Stanley, that's down by about 0.4%. Citigroup, that's still higher by about 1.5% here right now. Taking a look at some of the regionals where a lot of this activity has really been in focus, especially following that midpoint of March and early March, the crisis really ensuing here. And even as some of that sentiment starting to at least abate for the time being around whether this is still a crisis or not, some of the focus on regional banks continues to be very present here. Take a look at PNC, one of the banks. Of course, there were many who were said to be involved within the deal talks to try and get the assets of First Republic Bank. PNC has been one of those banks that was in conversations there, at least expected to have a bidding opportunity there. That's down on the day by about 4.5% here. And we'll just put this on an equal view just to give you a kind of sense of where the deepest declines are. Yeah, PNC as of right now. You've also got Signature Bank here. Well, we know which way that went anyway. That's done. But also just lastly here, taking a look at that NASDAQ 100 as we get closer to the start of today's trading activity. Big week of earnings. Of course, you're going to see Apple, that one of the components of the NASDAQ 100, that right now here starts off the week down by about 0.1%. Coming up, the world's largest bank in the U.S. just got even bigger, as we were mentioning and have been covering for you this morning. What the First Republic takeover means for JPMorgan next. Turning now to our top story. First Republic Bank sold to JPMorgan Chase this morning in a government-led deal meant to stave off bank instability. First Republic's failure is now the second largest in U.S. history after the collapse of Washington Mutual in 2008. Here with more, we've got Yahoo Finance's Inez Ferre. Inez?
Guys, and new details are surfacing about this deal. JPMorgan CEO Jamie Dimon and CFO Jeremy Barnum were on a media call this morning. Barnum pointing out that JPMorgan did not seek out the deal, but it does have benefits for the bank. Now, JPMorgan acquired about $173 billion of First Republic's loans, $30 billion of securities, and $92 billion in deposits. The FDIC, the agency which insures depositors, agreed to share losses on certain residential and commercial loans, giving JPMorgan some protection if those assets go bad. Now, the executives also pointed out that the bidding process over the weekend was competitive. Here's what Jamie Dimon, chairman and CEO of JPMorgan Chase, had to say on the call. Take a listen.
This is actually a very good outcome for everyone because this is how the system was meant to work. No systemic SRE, systemic, whatever you call that. It was put up for bid. It was competitive bidding. Cheapest cost to the diff, which the FDIC said will be something north of $13 billion. But remember, and everyone should remember, that diff is paid for by the banks. So I think you're never going to have no bank failure. So if this is how these things work in the future, that's a rather good thing.
Now, PNC Financial was reportedly one of the bidders. It's worth noting also that the number of commercial banks in the U.S. has been getting smaller and smaller. And last year, there were 4,135 banks in the U.S., down from 7,088 in 2008. Now, one of the points that had been made prior to today's tie-up is that JPMorgan had already accumulated more than 10% of U.S. deposits, making it ineligible to acquire another bank. Also, remember that after the collapse of Silicon Valley Bank in March, JPMorgan was one of the banks to which depositors flocked to because they were too big to fail. Now, obviously, working with the government, regulators have signed off on this deal, so the details surrounding those sort of behind closed doors conversations may surface in the coming days, guys.
Yeah, indeed. But they did make the point that the government asked them to come to the table.
That was very important, and very important that Jamie Dimon said that right off the top. The government has asked us for this.
Right. Indeed. All right. Thank you, Inez. All right. Continuing our coverage of today's top headline, the buyout of First Republic Bank by JPMorgan Chase is set to make the biggest bank bigger, even as banking continues to undergo a confidence crisis spurred by higher interest rates. Joining us now to chat about how we got here and what can be done to stop the collapses, William Cohen, founding partner of Puck News. Bill, thanks so much for joining us. Let's get right into this. What is your takeaway from what's occurred from yesterday through today? First up.
Makes absolutely perfect sense. The government, the feds had no choice. Frankly, JPMorgan Chase is the best buyer of these assets with a big assist from the Fed. And Jamie Dimon is absolutely right. There's always going to be bank failures. It's the way the system is designed. We collectively, as a society, have decided we can kind of put up with it every 10 or 15 years, as long as it doesn't bring down the whole economy. And this little it's hardly little, but the failure of these two large banks in the last 2 months has been largely contained, I believe. And, it's an acceptable risk that unfortunately we have to agree collectively we're going to assume.
Hey, Bill, Brad here. Is there any significance around the timing of this deal? Because this comes after First Republic had reported earnings where they disclosed that they were down, 41% in terms of the deposits declining 41% during the first quarter, which was really mired towards the end of the quarter. By the end of, or at least that final couple weeks in March, because of the collapses of Silicon Valley Bank and then Signature Bank and First Republic getting pulled into that as well.
Brad, the failure of First Republic was inevitable after Silicon Valley Bank failed and Signature failed. It's another what I call niche bank. It caters to a very specific clientele. It made a series of rather questionable risk management decisions, as did Silicon Valley Bank, as did Signature. And these banks are failing for a reason, a combination of major loss of confidence, which of course is the end of any bank, and two, bad risk management decisions on the part of the bank management. When you make big mortgages, jumbo mortgages at below market interest rates as your business plan, it's great for your borrowers. My goodness, no wonder they're so popular. They probably had borrowers who loved them, but it's very bad risk management, especially in an environment when you just know that interest rates are on the way up after 13 years of the Fed manipulating interest rates down. So bank management is a major reason for these failures as well.
So, Bill, Jamie Dimon said on the call they had today that they didn't ask to be, the government asked JPMorgan Chase to come to the table. But JPMorgan Chase is the nation's biggest bank, and now they're even bigger. Talk to us about the optics of this and the potential fallout from that.
You know, I'm sure there'll be criticism of JPMorgan Chase continuing to get bigger from the progressive wing of the political spectrum. And of course, you know, the Fed had to approve this because, you know, they're going to exceed the 10%, deposit limits. But again, they're the best buyer. They're the best run bank. They're our biggest bank. You know, as was just pointed out, I mean, we have something like 4,500 banks in this country. Other countries have national champions, many fewer banks. We have more banks probably than any country in the world. And that number is obviously going down and consolidation will continue. But you have to remember, after 2008, basically the Fed would not allow the big Wall Street banks, the SIFI banks, the systemically important financial institutions, to do M&A deals. I mean, Goldman Sachs should be doing deals left and right, but the Fed won't let it. And JPMorgan Chase has been doing small sort of fintech deals, but has not been allowed to buy a big bank, anything like what happened today with First Republic. And they had to get a waiver. And Jamie Dimon is right. I mean, you know, when you're the best run bank, the Feds are going to come looking to you to, you know, dig itself out of a crisis.
And so because the Feds gave JPMorgan, gave Jamie Dimon that call, as a result of this deal, is the competitive landscape in the financial services industry, and especially for the assets that now JPMorgan is able to take on, does the competitive landscape become better or worse for end consumers, end customers of the banks?
You know, there's still so much competition, Brad. Incrementally on the margins, does this take some of the competitor out of the market? You know, don't forget First Citizens or Citizens Bank got Silicon Valley Bank. These are niche banks, if you will, as I like to say. This is not nearly the magnitude of the change in the competitive landscape that happened after 2008, when both Bear Stearns, Lehman Brothers, and Merrill Lynch got taken out of the competitive landscape. This is totally on the margins. I don't think consumers will be affected one way or another. You know, already JPMorgan Chase, I'm a JPMorgan Chase customer, they basically pay nothing for your checking and your savings deposits. I don't think you can get any closer to zero than they already are. So I don't think that's going to change one bit. And, you know, think of all those uninsured deposits that are now feeling pretty great right now, knowing that JPMorgan Chase stands behind them. So, this was the inevitable outcome. This was a win. It's kind of like a major blip. We won't even remember this in 10 years.
Okay. Bill, one more quick question for you. You talked about the numbers that Inez mentioned in her reporting about the number of banks still, though it's down from the levels we saw during the Great Recession, the financial crisis back in between 07 and 09. Is there a need, from your view, for further consolidation within the banking sector?
I mean, if the Fed will allow it, you know, absolutely. It is allowed some smaller regional banks to combine. That's how I think we got Truist, one of my favorite banking names of all time. So absolutely. I mean, there's just too many banks, and there will continue to be consolidation. But you know, it's going to be the Fed is going to be the one to decide whether that can happen, not really the marketplace.
Bill Cohen, founding partner of Puck News. Bill, always a pleasure to get some of your insights, and thanks for the context around this.
Thank you.
Definitely. Time now for our trending ticker, and we're watching Norwegian Cruise Line. rising on earnings that beat expectations and an optimistic outlook. The cruise operator reporting revenue of $1.82 billion, blowing past, or should I say cruising past, the $1.74 billion estimates, and saw narrowing losses. This as the travel industry gears up for another summer of high demand as COVID concerns continue to wane. Coming up on the other side of this short break, Bitcoin eyeing its fourth straight month of gains, but it is pulling back from some gains today. We're going to discuss that next.
Regional bank instability once proved a tailwind to crypto as investors sought safe havens, but a slide in crypto reflecting deeper uncertainty in finance. Here with more, Yahoo Finance's Rochelle Akufo. Rochelle?
Hey, Diane. Well, a lot of people asking, is it goodbye crypto winter, hello crypto spring? Not necessarily. I mean, we did see that Bitcoin was teetering near that key 30,000 level that it hit back in mid-April before falling, as we're seeing this morning here, along with some of these other cryptos as well. Now, this would have marked 4 months of gains to close out April. Now, the last time that we saw a longer stretch, well, that was of 6 months, and that kicked off the rally of March of 2021. Now, the rally that we're seeing this time has correlated with this uncertainty that we've been talking about in the financial system, stemming, of course, from the recent bank collapses. You also have a weaker US dollar year to date, and, of course, the eventual Fed pause and pivot in interest rate hikes that a lot of these crypto enthusiasts are banking on. Now, of course, when the Fed's balance sheet jumped by about $400 billion to help shore up those failing banks, we also saw Bitcoin rally then as it effectively acted as another rate hike.
And so, is it too early to call it a crypto spring, Rochelle? I think I know the answer here, but let's put it out there for conversation.
I'm going to put a sprinkle of perhaps, because what we're really looking for here is consistency. According to Bloomberg's data, in the past decade, a 4-month winning runs for Bitcoin, that foreshadowed an average surge of 260% over the subsequent year. However, of course, spring can be a very temperamental season. And this time around, we have JPMorgan buying First Republic, adding that stability back into the financial system after we did see some of that flight into crypto. We're also still waiting to see just how many rate hikes the Fed is counting on when you have a credit crunch and a looming recession and consumers tightening their purse strings and perhaps looking for less risk. And then, of course, core PCE, a key gauge for the Fed, still showing that the inflation fight isn't over yet. And of course, the biggest cloud over crypto is the lack of clarity on regulation. Just on Friday, at CoinDesk's Consensus 2023 event on the industry, Blockchain Association CEO Kristen Smith noted this standoff between the industry, SEC Chair Gary Gensler, and Senator Elizabeth Warren, saying, quote, "We're going to probably be at war for the next 18 to 20 months. And of course, Gensler already singling out Bitcoin as the only crypto asset deemed as a commodity versus a security. So while it does set the tone for crypto market swings, Bitcoin's challenges are a lot more nuanced from the rest of the crypto pack. So not quite a crypto spring for everybody just yet, Brad.
Not yet. All right, get your allergy medication ready. Rochelle Akufo, thanks so much. Appreciate the update. And everyone, switching gears here, British semiconductor manufacturer ARM is finally gearing up for an IPO. The chipmaker announced it submitted a draft registration on Saturday to the U.S. Securities and Exchange Commission, known in your hood as the SEC. And they will reportedly seek to raise up to $10 billion, according to Reuters. The debut is closely watched here by SoftBank, which purchased the chipmaker for roughly $32 billion in 2016. And by a market seeing a slowdown in IPOs this year, a debut would make ARM one of the biggest offerings in the year so far here.
Yeah, definitely. People will be watching this one. We know deal activity in general, or IPO activity rather, has been slower but faster than the previous year in general with regard to the IPO market. So it'll be closely watched. You know, this coming after they had said they plan to seek a public offering after NVIDIA backed away from doing a deal. They had wanted NVIDIA to purchase ARM. So now SoftBank going to the public market with this, and IPOs in general closely watching because we haven't seen a leader yet with regard to that. You know, Ken Vu is, I mean, it's not your traditional IPO because it has the J&J history. It's a spinoff. That one will be closely watched. Investors certainly looking for a blue chip IPO, which will, you know, come to market. What would that be?
And this is going to be a big deal because there are not as many unicorns out there as well on the market.
Right.
2022 kind of dried that up a little bit, but there's still about, at the start of this year, at least 1,200, a little over 1,200 unicorns, companies with $1 billion valuations, which are typically looked to go public because some of these companies are already household names. Some of them just looking to get an additional cash infusion in order to continue their operations and hit profitability as well. So we'll see where some of those start to make their way into the public equity landscape as well. Coming up on the other side of this short break, we're going to head back to Milken, actually, where our executive editor, Brian Sozzi, spoke with the CEO of 23andMe on the next big thing for healthcare. Stay with us.
We've got a huge week for investors, big-time corporate earnings, a potential writer's strike in Hollywood, and oh yeah, the Federal Reserve's got a major decision on interest rates. Here are the 3 things you need to know for the week ahead.
Markets are bracing for some major earnings. Apple, Ford, Starbucks, and AMC are just a few of the top companies reporting quarterly results. Those will give us a fresh look at the health of American business. Plus, Hollywood's movie and TV writers could walk off the lot as early as Tuesday. The Writers Guild of America has voted in favor of a labor strike, giving studios until May 1st to agree on a deal. If a strike occurs, production of some of your favorite TV and film franchises could be delayed. And last, but definitely not least, the Federal Reserve makes its decision on whether to continue raising short-term interest rates. Signs of a slowdown in the U.S. economy could give the Fed reason enough to pause on their current rate hike policy. We'll hear from Chairman Jerome Powell on Wednesday. We've got you covered all week right here at Yahoo Finance. And be sure to tune in to After the Call on Tuesday and Thursday for a breakdown of some of the big earnings reports.
Bank failures aren't the only focus of this year's Milken Conference. Yahoo Finance's executive editor Brian Sazi is covering all of our bases. And Sazi, you had a chance to speak with the leader in the healthcare space. Who was this leader?
Hey, Brad, good to see you. Yeah, there's a lot going on here at the Milken Conference, 3,500 participants. And even while we continue to see what happens with the JPMorgan and First Republic on a big news morning in the finance industry, there is another theme here at the 26th Annual Milken Conference, and that is healthcare. It underlines a lot of the key panels here. And to that end, I got the chance to catch up with 23andMe co-founder and CEO Ann Wojcicki to get, who brought us inside her next phase of growth for her company.
We have over 50 programs underway with GSK. We do have one that is in a phase 1 study that GSK now controls. It's co-developed, but they're taking lead now. And there's a huge number of programs behind it. 23andMe also has our own wholly owned program. It's an immunotherapy program. So super excited about it. It is definitely exciting to see that you can go from understanding the genetic variation that makes me so excited to saying, wow, some people are, genetically not likely to develop, a certain kind of condition. And then can I understand that and turn that actually into a drug to help either treat people who have that condition?
Is that the holy grail in healthcare, looking out over the next decade, the ability to match up your genetics with figuring out the cure for cancer or some other disease?
I look at all the explosion of all these new technologies with gene therapy, with CRISPR, with RNA technologies, and understanding the human genome. And I think what 23andMe can really bring to the table here is the understanding of the human genome. So for instance, one thing that we can do really well is we study healthy people, meaning that you might have a particularly interesting mutation that the scientific world thinks, like they don't know, maybe it's potentially disease causing. But because I can study you and I can say, okay, you have potentially a knockout mutation, you're doing really well, you have no other health issues, we potentially know that like changing that or modifying that gene is not going to create any other kinds of issues. So it's a way to help the pharmaceutical industry study essentially what's naturally going on in humans. So we find like studying huge populations in huge numbers helps us just understand that natural variability in people.
And something to watch moving forward if you are an investor in 23andMe. Ann told me that in July, that exclusive deal with drug maker GSK, otherwise known as GlaxoSmithKline, that ends in July. So that opens the door for 23andMe to explore more partnerships, potentially with pharma players. Now, Ann didn't really decline to comment to me whether more deals are in the works and who she could be working with, but something to watch on a company that really came to market in 2021 during the SPAC boom at a valuation of about $3.5 billion, of course, merged with Richard Branson-led SPAC. Today, that market cap, if you go into yahoofinance.com, you look on the stats page, about $900 million. So very key, perhaps, for 23andMe to ink more deals to maybe get that valuation back up to the time of when it came public.
Saz, I just think an interesting note, this is not so much a question, but Anne and the relationship, I mean, Susan Wojcicki from YouTube, it'd be interesting to see what their genetics show, being that they're sisters and both business leaders, like top leaders in the world. I wonder what is in their family history, you know?
Whatever it is, Diane, I don't know if I have it, but clearly their genes are good. Those their three sisters, the Wojcicki sisters, are, right, I would say, fearless leaders in the world of business. Right. What they have achieved is absolutely mind-blowing, and they continue to do a lot of good work. But maybe I have to get my genes tested, Diane. Maybe I have some of what they have. Unclear to me.
I hear they like to have a lot of highball energy drink as well, Brian. So maybe that's a path you're already on.
Well, I think that has ruined my DNA, Brad Smith. Maybe I don't have any DNA left because of all this stuff I've ingested the past decade. Unclear to me, but maybe I should take a 23andMe kit and I can report back to you at some point.
Just briefly, on a serious note here, I mean, there's been so much investing in STEM and making sure that there is a talent pipeline. Did they have anything to offer on employment within the healthcare landscape and perhaps where the business is continuing to or starting to attract more talent?
We got into that a little bit, Brad, and you can watch the full interview on our homepage very, very shortly. But I think what Anne would like to see more gene focus and more topics taught in schools, not just high school, but also colleges. It's something, it's a topic I need to go back more into and see where these topics in gene therapy and DNA are in fact being studied. But she really made it clear that what she is focusing on, her company, is really not embedded into many areas of the healthcare industry, and in fact, maybe it should be.
Very interesting stuff there. All right. Thank you so much. And stay tuned for our Brian Sozzi's interview with the CEO of Apollo Global Management coming up at 10:45 a.m. this morning. But on the other side of the break, to the big screen, we'll speak with the CEO of IMAX on why the company is doubling down on international markets. That's next. IMAX shares saw healthy growth in the first quarter. In fact, the stock up today, actually. The entertainment technology leader posted its highest grossing Q1 ever, as well as its greatest first quarter market share. CEO Richard Gelfand noted on the conference call that the business is more global than ever. He's with us today, as many of its signings for new IMAX systems came from high-value international markets, and a third of its global box office was driven by non-Hollywood films. He joins us now in studio to discuss. Let's get right into it. What is the takeaway that we should have from your latest report?
I think, you summarized it really well. It's becoming internationally more and more global. IMAX is in 90 countries today. Our signings, you mentioned, we had 63 signings through the end of April, which all of last year we had 47. So, that just shows you our global momentum. They were in places like the Philippines, Indonesia, Japan. We had a lot because those markets are really booming. And 1/3 of our box office in the first quarter was from international foreign language films.
Right.
So Japan, India, China, but it wasn't only Japan in Japan or India in India. There's a film in Japan called Slam Dunk, which did $5.5 million in China the next weekend. They packaged some TV shows in Japan called Demon Slayer, and it did $1 million in Korea. So this is kind of a new global trend, which is making IMAX more than just Hollywood blockbusters, but global blockbusters.
Right, and I know our Ali Canal has some questions for you too.
Yes, Richard, so given that your business is so global, how do you approach an event like the Hollywood writers' strike, for example? Are you more insulated from that impact considering this international focus?
Yeah, we're definitely more insulated, as I said, because about 1/3 of the revenues in the first quarter were from foreign language films. I think nobody's completely insulated. However, the movie slate for this year is pretty well locked. So again, IMAX does Hollywood blockbusters, and those aren't ones, hopefully, if you're a studio, that aren't being cobbled together at the last second. So things like Fast 10, Mission Impossible, Oppenheimer, they're largely in the can. Dune is done shooting and it's being edited. So, for films coming out this year, the strike really doesn't have an impact. It's a question of how long it goes on for and what happens next year. The good news on that, I think people have been anticipating it. So I think a lot's been written for next year. So we'll have to watch it just like you do.
How early on in the process of even conception of a new title or any content do you get involved in conversations where possible? Because that's a different type of production that production studios have to consider, that videographers, anything that's going into any type of entertainment piece that would be displayed in an IMAX platform.
It depends on who the filmmaker is, Brad. So if it's Chris Nolan or it's Denis Villeneuve, and part of their vision is the IMAX of it all. So we may find out 2 years earlier or 3 years earlier. And in the case of Oppenheimer, we have an IMAX team kind of embedded in Chris's production crew, just so he can maximize the IMAX opportunity. If it's another kind of film, I'm trying to think more like Indiana Jones, which is coming out, which I've heard great things about. That's one that it's not shot specifically for IMAX, so that typically will get involved 6 months before.
And Richard, I know you're very bullish on the comeback of theaters, and there's reason to be, right? The Super Mario Brothers movie just surpassed $1 billion globally after debuting in Japan. We have that strong slate coming out this summer. But you were just at CinemaCon, which gathered the top industry executives, the top exhibitors. What is still a concern in your industry right now?
So, Ali, you may remember, because we've talked a lot, that I was bullish before this all turned around. Because I think a pandemic doesn't change 100 years of behavior. At CinemaCon, I think it varied by region. So I think China, which just came out of lockdown in December, is doing well, but it's not back full bore. I think the rest of the world, Southeast Asia and Europe, they're just killing it. Places like France, Japan, other places in Southeast Asia, Taiwan, India, they're all back. And I think the US is somewhere like, in my opinion, 85% back. I think the pandemic doesn't keep people at home, but a lot of the exhibitors in the US who license our technology, had a tough go of it. So I think they're coming back a little slower. With that said, we had our biggest signing in the US in a decade that we announced as part of our quarter. So I think we're starting to see positive signs. The other thing about CinemaCon, I think people are really upbeat about the slate. I mean, April, the only big movie was Mario. But for example, our box office is more than double last year for not what you would think. But here we are, where Guardians of the Galaxy is coming up this week. Then Fast and Furious right after that, then Little Mermaid, then Flash, which got terrific reviews coming out of CinemaCon, and then you go into Indiana Jones and you go into Mission Impossible, and there's so many, I'm missing some of them.
That's all right. I know you're trying to go through your brain to come up with all of them. There's so many coming up. But one thing, so obviously we knew Avatar: Way of the Water was a huge hit, blockbuster film. Creed was an unusual choice for choosing IMAX. Do you see, or what are your expectations for more films taking that path?
Well, I mean, I think you chose a really good example, because Creed was a sports film. We'd never really done one before. But I think that Michael B. Jordan really wanted to do something that would make the film stand out from the pack. And that's kind of what IMAX does. We're a global curator of films. So when people see, wow, it's an IMAX, they think it's something really special. And actually, I had the privilege of getting to know Michael through the process, back to your question, Brad, because he was filming with IMAX cameras. That's one where we were involved for a while. And
you gave him the workout process for Creed, right? He can credit you for that.
I told him I'll kick his butt if he doesn't do a good job. He wasn't very worried, though. I don't know why. I can't understand it.
Well, I'm still waiting for that intro, right? You're going to intro me to Michael B. Right?
We're going to have to fight over this one, Allie. I'm sorry.
Well, Richard, real quick, you said the U.S. is about 85% back. What will it take to get to that 100%? And when can we expect to reach pre-pandemic levels?
I think probably later this year or next year. One of the really good developments is people like companies like Apple and Amazon are releasing films theatrically first. The narrative that to go right to streaming has been thrown away. Like, that experiment just didn't work. It failed. So one of the big things about CinemaCon, which you asked about a minute ago, was the Scorsese film is coming out first on Paramount, then it's going to streaming. Napoleon is going through Sony, then it's coming out in streaming. Creed, which you mentioned, was an Amazon MGM release. So theatrical has lost some movies because the mid-level movies are going to streaming, but they're gaining movies now from streaming. And some of those movies like Napoleon and the Scorsese movie look fantastic. So I think that'll fill in that gap. There'll just be a little lag.
When you look at the consumer environment right now, consumers are looking to where they can cut costs. And unfortunately, it's also a question of, okay, can we pay for an IMAX experience versus just seeing the normal run-of-the-mill movie experience? So how do you discuss with your partners how to make it more economical for consumers who want to go see these titles?
Well, the exhibitors set the price. We license our technology for a percentage of the box office, but they set the price. And I think, frankly, because of inflation, right now it's been fairly easy for them.
Do you think it's excuse-flation on their part to keep the price higher?
Well, I mean, you look at their financials, I wouldn't say so. They'd have a tough go of it. I think it's make up for pandemic inflation rather than excuse inflation. But movies are still a very affordable kind of entertainment, even IMAX movies are. You compare it, I don't know about you, but when I go to a restaurant, I'm like shocked. Or I buy an airline ticket, I say, there must be a problem. There's an extra zero on that ticket. So that kind of thing you kind of give up. But I think going to the movies, it's a way to get away. And look, we just talked about Super Mario Brothers. That's an animated film. And for IMAX, our market share on opening weekend for that was 8%, whereas for Frozen, it was 6% years ago. So I think people are really in, post-pandemic, doing something special, getting out of the house, paying for the best, same kind of trends you're seeing in concert and sports. So I think there's less price sensitivity than you would think.
That, Richard, is what we call a Mario Party. Richard Gelfand, who is IMAX CEO and Yahoo Finance's own Ali Canal. Ali, thanks so much for joining us this morning.
Thank you.
Richard, thanks for joining us in studio. Great to have you.
Thank you so much.
Absolutely. Coming up, everyone, on the other side of this short break, with global deal-making slumping, what does the latest bank failure mean for the space? We're going to head back to the Milken Conference, where our own Brian Sazi was going to speak. He's speaking with the CEO of Apollo. That's next. Global deal-making wasn't exactly on the up and up in the weeks before Silicon Valley Bank failed in March. Since then, the landscape for both public and private markets has been uncertain, to say the least. It's been this way for a while now on both volume and value. 2022 was a muted year for PE activity on a relative basis. A recent report from S&P Global tells the story. Market volatility has been the biggest challenge to closing deals in the last 12 months. It's been a slightly different story for take-private deals, however. Last year, tech was the focus, with PE lured by significantly marked down prices. Private equity doesn't come much bigger than Apollo Global Management, the parent company of Yahoo Finance, and it's been making big moves in that space. Just last month, it struck a deal, huge deal, to acquire and delist specialty chemicals distributor Univar Solutions for $8.1 billion. That company, the latest in the string of deals for the PE giant. So are they bucking a wider trend, or is this a sign of things to come for the industry? Let's get to Yahoo Finance's Brian Sazi at the Milken Conference in Los Angeles. Brian.
All right, thanks so much, Brad. Of course, joining us now is Apollo Global Management co-founder and CEO Mark Rowan. Mark, good to see you here this morning. Lots to talk about on the future of Apollo, but we have to start with what we saw this morning. JPMorgan scooping up a First Republic. Your thoughts on this deal?
Strong gets stronger. I mean, JPMorgan has run a conservative balance sheet. They run a fortress balance sheet. In times of stress, they benefit. It's no more complicated than that. But I do think that this is not a huge story. I know it's this morning, so we'll talk about it, but the three banks that have failed, totally predictable. Mark-to-market losses on treasuries, well known. Structure of the deposit base, well known. To me, the interesting question is, what is the future of regional banking going forward when 42 billion of deposits can leave in 4 hours? Not like, did JPMorgan buy or not?
What is that future?
I think it's going to be interesting. I think we're not going to know for a while, but I look at the business model. They have always paid more for their deposits versus the money center banks. Now cost of deposits are up. They're going to have more regulatory costs, whether there's more regulation or not. Their cost of debt, their cost of equity is up. But most importantly, are deposits stable? Are they sticky funding? Can they run a loan book, a NIM or spread-based business? I'm not so sure. So when the dust settles, I think there will be a real shakeout as to what the business is of regional banking going forward.
Do you see more mergers in regional banking happening?
I think that's a possibility, and there will be some. Certainly we're watching the weak players get taken out now by the strong players. I think, as Jamie said this morning, it's probably the end, but I would say the end of round one. I think we still have a lot of commercial real estate stress in the system, which probably will give rise to some round two.
Is round two does the commercial real estate market get roiled? We had Charlie Munger over the weekend in an FT op-ed sounding alarm bell on the state of the commercial real estate market.
It is roiled. I mean, if one looks at how the public measurement, take three of the best operators out there, take Vornado, take SL Green, take Paramount, and look what's happened to their stocks. The market has already told you it's roiled. And then you step back and you look at the diversity of asset class, debt, equity, mezzanine, all the different markets, all the different product types. I don't know that it will be systemically threatening, but if you're a regional bank, you made real estate loans in your region. If your region turns out to be weak, you're going to have problems.
A lot of the leaders we have talked to say that the banking industry is stable. Some have said it's strong. Do you see it that way?
You know, this is a complex dynamic. So is the banking system stable from a capital point of view? Absolutely. Is it stable from a business model point of view? If you're a large bank, pretty much. If you're a regional bank, as I've already suggested, I'm not so sure the business model is stable going forward. But I look at what's happened over a long period of time. 2008, Dodd-Frank, country made a decision to reduce their dependence on the banking system, government guaranteed deposits for funding. Today, banks are less than 20% of all debt finance in the US. Investors, people at this conference, pension funds, endowments, insurance companies, so on, they are the new banks. And so we are, if you step back, our system is the envy of the world. We're 50% of the world's capital. Our government benefits, our business benefits, our consumers benefit. I think it's likely to stay that way.
Are there opportunities for Apollo in an environment like this where we might see commercial real estate market uprooted, we might see more banking and regional banking consolidation?
Look, we are in the alternatives business. And alternatives to us are alternatives to publicly traded stocks and bonds, not narrow hedge funds or private equity or anything else. So I think about the last decade, while we printed $8 trillion, the irony is I'm not sure people needed alternatives or active management of any sort. The single best thing to have done was to bought the index, bought the 30-year, and worked on your golf game, or whatever else your hobby is.
My golf game's pretty bad right now, Mark. It's bad.
And now if you look going forward, we're just unlikely to have that kind of tailwind. Now is, ironically, when you need alternatives. Public markets, particularly public markets for fixed income, are all beta. They're liquidity-driven markets driven by open-ended mutual funds, ETFs, derivatives traders, and the like. If one wants alpha today, you need to step away from publicly traded markets, and you're seeing that. You're seeing the growth in private credit. For us, the bet we've made is investment-grade private credit. Very much akin to what a bank used to do, to what a GE Capital used to do. We are top of the capital structure, senior secured, and we've built a really large business. We are $400 billion of private credit today, which sounds large, but I assure you, Jamie Dimon, Jane Fraser, Brian Moynihan, Charlie Scharf, they don't wake up every day wondering what the mighty Apollo is doing, and I like that. Being large but not relevant in the scheme of this marketplace just affords me room to run.
At the core of a lot of the things we're seeing in markets right now, First Republic, JPMorgan, you name it, is what the Federal Reserve has done. Your take on what the Federal Reserve has done in terms of raising interest rates this aggressively, and we might see another rate hike this week.
Look, go back to 2008 again. We printed $8 trillion. That's a lot of money. Exactly what we thought would happen when we printed $8 trillion happened. Everything went up and to the right. Stocks, bonds, real estate, cars, wine, you name it. We withdrew a little bit of stimulus in 22 and everything corrected, lo and behold. But if you again step back, of the 8 trillion, 3 to 4 trillion ended up in the banking system. The banks had relatively low loan demand. The banks therefore put that money into treasuries. Interest rates go up, the value of treasuries go down. Now consumers act. Consumers who have lived with a decade of low rates, all of a sudden can go to money market funds and get 4 or 5%. Turns out consumers prefer 4 or 5% to 0.5%. $800 billion left the banking system. First Republic, SVB, Signature were just the most exposed. In plain sight, everyone knew.
The Federal Reserve, what have they done in terms of the private equity industry? Raising the rates where they have been, what have you seen in that particular area of the markets?
Look, I'm not sure the Federal Reserve has intended to do anything in the private equity industry, but let's talk about equity. When rates are down and credit is free and liquidity is plentiful, everything moves up and to the right. And the more risk you took, the more elongated your business plan, the further up and to the right you were. And so public equity markets, technology growth, clearly succumb to the siren song of liquidity. People now have to figure out, were they good investors or was this all market beta? Private equity was not immune to that. 60% of the money that was invested in private equity over the last 10 years was not traditional private equity, it was growth. And while it was happening, it felt really good. And now that it's not happening anymore, it doesn't feel so good. And so you have firms like ours who are purchase price matters, excess return per unit of risk. We did just fine over 10 years, but this is the period of time when liquidity has been withdrawn, when we're playing offense and lots of playing defense, that I'm excited about. This is what we're made for.
Is it a recessionary backdrop?
It is a recessionary backdrop, but as I have sometimes said, I think we're going to have a non-recession recession. And what that means to me is those of us in the asset world, you who live in the reporting on an asset world, we're going to feel like we've had a real recession because everything that went up is coming down. But if you look at the numbers, 3.5% unemployment, strong wage gains, continued job growth, we have yet to feel the infrastructure money that was passed by Congress. We have yet to feel the stimulus of the Inflation Reduction Act money. It's very hard for me to see where we will have a classic demand destruction pattern of the kind of magnitude that we historically have associated with recessions or deep retrenchments from the kinds of excesses we've seen.
Do the portfolio companies that Apollo owns, are they telling you they have started to see their business slow down?
No. You're seeing perfectly fine business trends. If we actually shut off all the news sources,
but can't shut off Yahoo Finance.
Everything except for Yahoo Finance.
Just want to put that out there.
It would actually feel pretty good.
Talk to us about your overall market outlook as you look towards the back half of the year. Maybe a couple more rate hikes. What does that suggest to investors that are actively involved in this market?
Look, I step back and I'm going to again try to put it in a macro sense. I think we live in a bifurcated market, and I think we've been lulled into some passivity over the last 10 years. And what I mean by that is when everything is going up and to the right, not a lot of questions are asked. People puff their chests and they say, well, that's because of great management. I don't think that's the market we're in. I think we're unlikely to have any tailwinds. People are actually going to need to figure out how to be good investors going forward, and we have not yet mentally adjusted. What happened over the last 10 years is abnormal. I come to where we are today. Are valuations low? No. Are rates high? No. Is liquidity low? No. Spreads wide? No. What we're living in is actually normal. What we've been through is the abnormal period of time. We have so many people who have just not mentally adjusted to that. But that's the business we're in. We're in the business, purchase price matters, excess return per unit of risk, and in a market that has adjustments, corrections, deviations, stresses, that's an Apollo market.
Mark, you have touched every part of the Apollo organization. As you sit atop your perch now as the CEO of the company, does PE still get a bad rap? That PE comes in, ravages companies, lays people off. How do you see it?
I think the market, first of all, was never like that, and it's certainly not like that today. This is a 35-year-old business where there are not a lot of obvious things one can do by simply buying the company and breaking it up or laying people off. This is now all about building. And what's interesting, you think about the structure of the market today, 60% plus ETFs, everyone is daily liquid. Who are the long-term investors in equity? I just haven't met any of them recently. We buy something, we operate the business as if we're going to own it forever. And if we make decisions as if we're going to own it forever, we usually will make the right decision. Whether we own it forever or not is not the point. We make decisions that are long-term, that will pay off, and we're not measured in quarters. It is one of the real luxuries of our business to be able to think long-term and not care what happens on a quarterly basis. You don't make long-term investments if you're measured quarterly. You don't make the kinds of bets to fundamentally change business models if you're measured quarterly. And when you own the equity, particularly in a concentrated way, it has a way of focusing the mind on getting good outcomes. The whole notion or soundbite of private equity as ravaging businesses was always that, just a soundbite.
All right, we'll leave it there. Apollo Global Management co-founder and CEO Mark Rowan, good to see you. Thanks for spending some time for Yahoo Finance. We appreciate it.
What's better than this? Thank you.
Not much. Brad, back to you.
Great stuff there. Our own Brian Sazi at the Milken Institute Conference alongside Apollo Global Management CEO Mark Rowan. Stay tuned for our 3 to 5 p.m. hour. Brian's going to be back for a discussion with Citi CEO Jane Fraser. You don't want to miss that. Plus, Rochelle Akufo has you for the next hour of trading. She's going to speak with the CEO of SoFi on the back of those earnings. You don't want to miss that conversation either. From myself and Diane King Hall, have a great rest of the day.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Too big to bail. JPMorgan just got even bigger after taking on First Republic. Jamie Dimon says the government asked it to step up. But as Wall Street points out, it's not a bad deal for JPMorgan shareholders either. We'll discuss. And another huge week for results sees Uber, Qualcomm, Yum Brands and Apple all hit the tape. That's a huge cross-section of the economy accounted for there. We break down the metrics that will matter the most. And caught in the crossfire, SoFi's personal lending business delivers the goods, but shares yo-yo. It may be a different bank to SVB and First Republic, but is there any read across from the turmoil? That's also just ahead. But first, let's check in on how the major indices are faring. We're seeing some buying action picking up here as we're an hour and a half into the trading day. The Dow there up about 130 points, about 0.38%. The S&P also seeing gains there, up about 1/3%, being dragged down by the energy sector-wise. Taking a look at the Nasdaq there, also just barely in the green there as well, up about 20 points. 0.16% as we see JPMorgan bringing some stability there to the financials and the banking sector. Let's also check in on the Treasury market as well. We're seeing that the 5-year here up about 1.8% there. Stronger though in the 10-year, we look there up about 2.2%. And the longer term 30-year yields there, 2.6% as we take a look at those yields. Right, well, turning now to our top story. JPMorgan Chase snapping up First Republic Bank as the government tries to head off wider bank instability. The move making JPMorgan bigger than ever and raising eyebrows over its size. Joining us with more, Yahoo Finance's Inez Ferre. Hey, Inez.
Yeah, Rochelle, and the big banks are getting bigger, and that's raising eyebrows, as you mentioned, even as shareholders and investors cheer on the moves. The number of commercial banks in the U.S. has been getting smaller. Last year, there were 4,135 commercial banks in the U.S., down from 7,088 back in 2008. Now, it's worth noting that JPMorgan is already the biggest bank in the U.S. with more than $3 trillion in assets under management. One of the points made prior to today's tie-up is that JPMorgan has already accumulated more than 10% of U.S. deposits, calling into question its eligibility to acquire another deposit-taking firm. Now, this may be part of the reason why JPMorgan's Jamie Dimon highlighted this morning the government invited us and others to step up and help. This morning, bank executives on a media call said the bidding process for First Republic was competitive. Here's JPMorgan CEO and Chairman Jamie Dimon.
This is actually a very good outcome for everyone because this is how the system was meant to work. No systemic SRE, systemic, whatever you call that. It was put up for bid. It was competitive bidding, cheapest cost to the DIF, which the FDIC said will be something north of $13 billion. But remember, and everyone should remember, that DIF is paid for by the banks. So I think you're never going to have no bank failure. So if this is how these things work in the future, that's a rather good thing.
And the street is mostly positive about this deal. JPMorgan shares are trading higher, up more than 3% right now. Wells Fargo analyst Mike Mayo told clients the deal seems positive for JPMorgan and the industry. And Citi analyst Keith Horowitz pointed out the deal made sense strategically and is all about accelerating the growth in the U.S. wealth management business, where First Republic has been able to gain share in the past. Rochelle.
All right, appreciate that update there, Inez Ferre there for us. Well, as we know, a run on deposits brought down Silicon Valley, Signature, and most recently First Republic. Will more banks be pulled under by this deposit run riptide? Here to break down the outlook is Gerard Cassidy, RBC Capital Markets Managing Director. Good to have you on the show here. So a lot of people wondering, is this deposit flight over? Is this contagion now contained with this rescue now from JPMorgan?
I think it is, Rochelle. In fact, when you look at the business models of the three banks that had these deposit runs, those business models are very, very different than your typical bank in the United States. And when you take a look at the core consumer deposits, those are the deposits less than $250,000 that are insured in a company like Silicon Valley, they were less than 3% of total deposits. Whereas your typical regional bank in this country has anywhere from 40 to 60% of the deposits less than $250,000. So that's why we're confident that the run that you've seen in these three banks will not be replicated with other large banks.
And First Republic didn't share the exact same risks as SVB and Signature Bank, but why do you think there was continued pressure on First Republic then that got it to this point?
Very good observation, Rochelle. You're right, the risks were quite a bit different. And when you take a look at the First Republic funding, they all had the issue with funding. That's what's caused these problems for these banks was deposit runs or deposit flight. And anytime you have deposits that are over $250,000 that are not commercial operational deposit accounts, they're susceptible if there's a fear that there's going to be some sort of loss when you mark to market the asset side of the balance sheet because rates have risen. That money is susceptible maybe to leave, and that's what, of course, happened. Now, if we didn't have a Silicon Valley, we certainly would never have seen what has happened here at First Republic.
That's one of the things that makes it sort of tough to predict, the next shoe to drop or just how long we're going to be feeling the repercussions from this. And we did note Jamie Dimon saying this was the government asking, big banks to step in here. And it did require that regulatory waiver given the size of JPMorgan already. So what does this do then positioning wise for JPMorgan and these other big banks now that it's essentially gone over that 10% threshold?
True, and JPMorgan Chase and Bank America are over those 10% thresholds, and you're permitted to go through them through organic growth, but you're not permitted to make acquisitions unless the government invites you in a failed situation, which is what we have in this case with First Republic. And so I think what you're seeing is, even though you take a look at the market here in the United States, it's still a fragmented market when you compare it to a Canadian market. So if you look up in Canada, there's basically 5 banks that control the banking markets up there, and they all have anywhere from low 20% to mid 20% market shares. Here in the United States, as you pointed out, JPMorgan Chase is the largest, but their market share in deposits is in the low double digits, as you mentioned.
And as we speak about JPMorgan, that was one of the banks that Warren Buffett's Berkshire Hathaway started reducing positions in. But that was obviously starting back in 2020. But they also added Goldman Sachs, Wells Fargo, M&T Bank, and PNC Financial to some of the areas they were reducing their holdings in. What do you think perhaps Buffett was looking at when he saw this, and how much we might actually potentially hear about more of that?
I do think you're going to hear more at their annual meeting about their bank stock investing strategies. Over the years, as you pointed out, Berkshire Hathaway has been a bank stock owner. They have less exposure today to the banks. I saw Charlie Munger was quoted in the Financial Times being a bit concerned about the commercial real estate exposure that the banks have. So I certainly expect them to discuss that further at their annual meeting as well. But through the cycle, with strong banks like a JPMorgan or a Bank America, investors still can make money. And we have to remember, Berkshire Hathaway has got a good track record of being able to step in a time of distress and make an investment and do very well like they've done in the past. They just haven't had the opportunities yet to step in situations that they find favorable to them.
And it's interesting because they did also start building up some more positions in Citigroup, Ally Financial, Jefferies, New Bank, Bank of America as well. So is it about a bifurcation of what we're seeing in terms of the banking industry, or what do you think is driving some of the areas that they're choosing to build up in for these banks?
I think it has a lot to do with value. When you take a look at the numbers, we don't cover Jefferies, but Ally, Citi, and Bank America, particularly Citigroup, stands out when you look at their stock relative to their book value or tangible book value. It's trading at a significant discount. And when you look at a value investor like Berkshire Hathaway, that makes it very attractive to an investor who has a long-term view when they come to making investments. As you know, that's the approach that they've always followed. Same thing with Ally and Bank America. Their discounts are not as substantial as Citi's, but they are discounts to book value. And that's what they look for as a value investor.
And certainly that signature move of playing the long game there for Berkshire Hathaway and continuing that even in their approach to banks as well. A big thank you to Gerard Cassidy, RBC Capital Markets Managing Director. Thank you for joining us this morning. All right, time now for our trending ticker. We're taking a look at SoFi Technologies. The digital financial services company reported a smaller than expected loss for the first quarter, with noting the company's record increase in total deposits up by 37% in a quarter that saw deposits flee regional banks in droves. You see there the stock there down about 10% on the day. Well, I'm diving deeper into those earnings with CEO Anthony Noto at 11:40 a.m., so stay tuned, you won't want to miss it. All right, coming up, the next few days give us a close look at some of the key sectors of the U.S. economy. Are people still getting a car instead of Subway? Are tacos in fashion? Is smartphone demand still an issue? We'll discuss all of that next. Turning now to our top story, who's heeding the Fed? High interest rates at the center of the failure of banks like First Republic come even as the Fed warns of a possible recession. The market may not be taking these warnings seriously enough, and the next dip might be just around the corner. Joining us now, Gareth Soloway, Chief Market Strategist at Verified Investing and Chief Market Strategist at In the Money Stocks. Good to have you on the show here. So, are you surprised that the markets aren't heeding the Fed at this point? I mean, even when we're looking at the VIX, even that's down 1.2% today at 15.
Yeah, it is a little surprising. I think this is part of the market cycle of complacency where the markets overall, we just came off of this big drop from 2021. And investors are starting to say, okay, the Fed may be looking to kind of pause here. They're still likely to hike at least one more time. But ultimately, the markets are getting ready for this pause. And I think that's drawing a lot of investors into the market. And you kind of create this scenario where investors, like you said, are ignoring the Fed. The Fed has said there's going to be a minor recession. The concerning part to me is that if they said minor, and last time, remember, they said, we would have this minor kind of issue with inflation, right? We were going to see transitory inflation. It ultimately turned out to be horrendous. And so I am concerned that investors are mispricing assets here. We see Pepe on the crypto side. We see the crypto runs going on again. And this is telling me that there's a lot of risk in the system.
And so people are taking a look at this, but then, as you mentioned there, markets really looking ahead to a pause and a pivot. But in reality, when you're looking at some of these indicators like inflation and unemployment, some of these stickier parts of inflation in particular, where do you see perhaps a pause or a pivot coming in?
Yeah, I think the Fed is starting to pay attention. We saw the last jobs number getting a little bit on the weaker side. It came in slightly lower than expectations. We've seen inflation coming down, and we've seen the banking crisis really continue with today's takeover by JPMorgan of FRC. So I think the Fed is aware of this. They don't want to kind of stop too quickly on the hiking side, so they're going to likely hike by 25 basis points next week. But I do think it's then open-ended, and the Fed may be looking to pause. The issue for the markets is that the market has always, and investors have always looked at it and said, hey, the Fed will bail us out if we get into trouble. The problem is in the past 15 years, inflation was sub 2%. We're now at a point where inflation is north of 3, 4, 5%, and the Fed can't bail us out. And I think that's where the mispricing of these equities is coming in, where you have NVIDIA where it is, you have Apple, you have Microsoft. All of these sky-high valuations are not pricing in a recession later this year.
So then when you combine what we're seeing with valuations, people are looking ahead at perhaps stagflation versus a recession. What is your take on that, and which one could potentially be more hazardous for investors?
I think the stagflation is a big issue, right? If we look at how stagflation attacks people where they're not getting more pay, they're actually in a recession or the economic growth is stalling out, but inflation is continuing up. That makes it very problematic for them to start spending more money as inflation on goods continues to cost them more money. So I think that's the bigger problem here. And I do see that as a forecast of what could happen in the second half of the year, where we still see inflation, even for the next couple years, maintaining 3-4%, but you do have a recession that drags on for multiple years without the Fed stepping in. And again, this is the kicker, is that investors continue to think that the Fed will bail us out of every situation, but we clearly hear from Jerome Powell that that's not likely the case unless things get really, really bad.
And to that point, you're expecting the stock market to drop about 20% potentially by the end of the year when reality does set in for investors. So how should people be positioning themselves so that they don't end up with a shock to the system?
Yeah, and that's a great question. So I think for me, it's looking at kind of defensive plays, right? You look at plays like gold miners. Miners took a big hit last year relative to the price of gold because inflation was so high. Their input costs were going up, but the price of gold was not matching that inflation. Now gold has started to take off. We've seen gold trading close to those all-time highs. I think gold does break out in the second half of the year. And I think you look for defensives that haven't run. We've seen the McDonald's have run already. We've seen GE is sky high. That's kind of being played as a defensive. We've even seen Apple as being a defensive. I think you start looking for the biotechs like the Amgens. People will still need drugs if we go into a recession. I think that's the angle. Play the beaten down defensive names and ultimately the gold and gold miners.
And for people who are trying to gauge sort of where we are in the market cycle, you know, the cycle psychology chart and how that's matching with what we're seeing with the S&P 500 potential here. When you look at where we could be headed at the moment, how far out do you think that anger phase is going to start kicking in?
Yeah, and this is amazing if you do, and you guys are showing it right now. If you look at the S&P 500 on a weekly or monthly chart, it matches perfectly up with just after the euphoria phase, that sideways to up consolidation that we've seen in the S&P for the last really 6 to 8 months. And that tells me we're in this what's called complacency stage, and it's just before the roll off of the cliff, which comes into that 20% downside projection in the market. So I think you could be looking at 6 to 12 months of pain in this market coming forward, and investors need to take heed. You're seeing things again like risk taking in the crypto markets, in the stock market with sky high valuations, and that is not the sign of a bottom in a stock market or in the crypto markets. It's a sign of a near-term top.
Yeah, when I saw that Pepe the Frog coin only launched 2 weeks ago, it is already now by market cap one of the top 100 cryptocurrencies. Yeah. It's certainly alarm bells going off. A big thank you there to Gareth Soloway of Verified Investing and In the Money Stocks. Thank you for joining me this morning.
Thank you.
All right, coming up, your favorite late night talk shows will be the first to get cut this week if a writer's strike goes ahead. But what's the bigger economic impact? We head to Hollywood next. Now to Hollywood and the risk of strike action. The last time writers put away their IMAX in 2007, it lasted 100 days and cost California's economy around $2 billion. Well, are we heading in the same direction this time around? Yahoo Finance's Ali Canal has the details. Ali, what say you?
Well, Rochelle, it certainly is a big cost because you have to remember it's not just these writers, it's the production crew, it's the stagehands, it's all of these ancillary businesses like limousine companies, catering businesses that will feel the ripple effect of this strike. You mentioned that quickly in the intro. If we take a look at the last writer strike, which lasted from November 2007 until February 2008, it cost the LA economy an estimated $2.5 billion. Now that includes wages lost by writers and other workers during that shutdown, along with those other Hollywood-dependent businesses that I mentioned. And although Hollywood is vital to LA, writing and production, those are industries that are really big in other U.S. cities as well, like Atlanta, Chicago, New York City, just to name a few. So the longer that this strike goes on, there are going to be continued consequences. Immediately, there will be an impact to late night television. There will be an impact to soap operas. We have heard from studio executives like Netflix, Warner Brothers Discovery, who said in terms of scripted content, they have a lot of content banked and that there won't be that immediate impact. Same with the box office. A lot of those films, due to that longer production time, the 2023 slate is going to be safe. But if this strike continues into the summer, into the fall, we're going to feel more and more of that impact in those cable shows, along with potentially some films heading into 2024. There are 11th hour talks right now. We'll see if a deal can get done before midnight tonight. But the general vibe in Hollywood is that it's inevitable that a strike is going to happen, but the hope is that at least it can be short.
I mean, and you figure the industry has changed so much since the last time, but why is this happening now?
Two words, Rochelle: streaming boom, right? And honestly, a little bit of the pandemic, because these contracts, they expire every 3 years. So the last time these negotiations took place, it was at the height of COVID. Both sides just wanted to keep the lights on. Now we're in this very different mode where we've been in this streaming environment for about 10 to 15 years now, and it's totally changed the way that writers are paid. So with streaming shows, there are less episodes. That means less money in the pockets of these writers. There's also less residuals compared to cable television. So they are saying and arguing that the model needs to change for how they are paid. Now, on the studio side, they're saying, well, look, streaming hasn't really been that lucrative for us. If you take a look at Disney, at Warner Brothers Discovery, there's billions of dollars of losses in their direct-to-consumer business. So there's this push-pull between the opportunity that streaming has provided, while at the same time, the major cost that it has on both the writing side as well as the studio side. And that's really where this contentious moment is coming into play. Again, we'll see if a deal can get done midnight tonight. That is what to watch out for.
Indeed. Well, thank you for getting us up to speed on that. Yahoo Finance's Ali Canal. Thanks so much. All right, coming up, the backlash against ESG has been catching the headlines for months now, but is it broad-based or just a state-level issue? If you want to play the space, how can you? We've got some ideas next. Investments aiming to improve environmental, social, and governance outcomes, also known as ESG, continue to face increased scrutiny, largely Republican states fueling the anti-ESG movement in the United States. Now, since the start of 2023, 26 states have proposed new ESG investing-related bills, many proposing multiple forms to restrict ESG investing with state assets. That's according to a Morgan Lewis study analysis. Now, Florida Governor Ron DeSantis has been among the most vocal critics. In December of 2022, Florida announced it was taking $2 billion out of the management of BlackRock, marking one of the largest anti-ESG divestments thus far. Though, despite the backlash, with some critics accusing companies of practicing what they call woke capitalism, TD Cowen believes ESG investing continues to move towards the mainstream. Well, in a new report, TD Cowen Washington Research Group provides a roadmap with key themes and policy areas that will be the most material to ESG investing and the best ideas by sector. Joining us now to discuss is John Miller, TD Cowen Managing Director. Good to have you on the show here. And we mentioned politics, which is one of these themes that you said is really going to be dominating the space here. Walk us through the other themes as well and how much they're going to be impacting ESG investing.
Sure, absolutely. So it's really interesting how much politics has come into the play within ESG. TD Cowen, we see ESG as a process, not a product. It's an investment framework. And one part of the report today really highlights four main themes we expect to see for the rest of the year through 2023 and into 2024. And so the first is, yes, this is clearly politicized in the US, and that's something asset managers and lending institutions just have to deal with. You can't fight that. You have to deal with that as a problem going forward. Some other interesting themes in this space are just disclosure, mandatory disclosure and reporting. That's coming. No matter how much individuals can sort of kick and scream about what the SEC is proposing around climate risk, maybe human capital management later than that, even if the United States doesn't move, the rest of the world is, and there will be a default towards a global standard likely coming out of Europe. So mandatory disclosure is coming. Two other really interesting themes that if you take a bigger step back, how climate policy has become so interconnected with trade policy and how climate policy has become so interconnected with industrial policy. When we think about the 2022 Inflation Reduction Act, it's generally framed as a climate bill. There's new investment tax credits, new production tax credits for solar, wind, and energy storage. But it's really an industrial policy bill about giving jobs and how the United States will compete in this market against China in the next decade.
So then when we hear a lot of the sort of public outcry about ESG investing, but in reality, what are we actually seeing companies doing in terms of really incorporating this in versus sort of having it as an add-on and having this backlash?
Sure, for sure. I mean, part of the backlash is that we always like to reframe this issue, right? So there have been historic left and right political issues for decades, right? Their views on, is climate change happening, right? Are human-caused drivers the main reason? That's a conversation that's taken place between Republicans and Democrats for the last 20 plus years. That's not new. It's simply evolved into a new space in finance and investments. And the same thing on the social side around reproductive health, around healthcare access. These are issues that have been fought out in politics and are now moving into a new space. So we always try and caution that this isn't really new for politics. It's just a new introduction to the space. So we've seen a lot of reactions already. Basically, a lot of managers are taking existing funds, right, which had been a value fund or a quant-based fund. In the past 3 to 5 years, they've maybe layered in a new ESG label on top of that, trying to expand access for that fund. And now there's some rethink of that. Is that what they're actually doing? Is it ESG first? Is it ESG second? Is there an impact element? So there's also a greater push towards definement of terms, right? What are you doing here? Are you trying to achieve a social good? Or is this really an investment framework to reduce risk and increase opportunity sets as the economy changes? So managers are changing the names of their funds. They're increasing their disclosure. They're more articulate about who I'm selling what. If you're going to a state in the United States South, you're very clear about this is what we're doing. This is the product. We'd like it to be part of your pension fund. That'll be a different conversation than if you have that same manager in New York City or in California. So there's a very clear breakdown between those. And as the data gets better, there'll be much more insight. The other element that's changing here a lot is how corporates are considering ESG. It's no longer just a sort of bolt-on kind of nice addition to the product. You're beginning to recognize that as the economy changes, as consumer demands change, as the regulatory structure change, this is a necessary piece of the framework that expands the pie, the holistic mosaic theory of investing, That is what ESG is, right? You're taking new data points that historically haven't been used in the investment framework, and you're allowing them into that process so you can better assess emerging risks and opportunity sets.
So against that backdrop, then, we want to quickly get to your best ideas then based on that. The sectors that stood out to you, you've got healthcare, diversified industrials, energy and sustainability, TMT, which is technology, media, telecom, and the consumer. Walk us through the top 3 big ideas that you think investors should really be honing in on.
Sure. So one of the reasons I think it's interesting, so this report is great. It's 50 plus actionable ideas across 5 of these very, very broad industry sectors. We had more than 30 analysts across the TD Cowen franchise participate. This is one of our best read reports throughout the year, right? And historically looking back. And why is that? Well, first, the main question we get from our institutional investor clients is, help me understand what's changing, what's the process, what's of conversation in the ESG space. So we provide some of that content up front along with those themes. And then the next big question is, okay, this is very exciting. It's interesting. What do I do with this, right? I'm an investment manager. I need actionable ideas. What should I buy, sell, or hold? So that's the bulk of this report, are those 50 plus actionable ideas. And we're really adamant that this is across the space. ESG is not simply for traditional oil and gas or utilities, right? It is across the economy. Now, the material factors will change based on where you sit and what sector or sector group. So if you look at TMT or you look at healthcare, the risk isn't biased towards E or emissions. It tends to be much more biased towards human capital management and governance. If you're in energy transition or traditional energy, of course you have that big emissions intensive footprint, and you need to understand that. Is that something that you can pass that risk on to your customers? Do you have a defensive moat there, or will you be exposed to increased prices for right now or externalities? So we really hit on that across the board. Our partner in this process is True Value Labs, which leverages a financial materiality data set and structure that was originally put together by SASB. What's unique about True Value is that they then take the ongoing conversation in that space and they can update that as it changed. So one thing that changed significantly post 2020 through COVID is that the necessity for supply chains, for value chains, and how corporations were engaging with their human capital management, their diversity structure became much more important. And so that framework was able to pick that up and understand those changes and appropriately sort of weight and score where companies sit in that. So when we talk about ESG, it's the entire S&P 500. There's not core to specific areas. And our approach is a little bit different too as well, where we don't create a siloed team to think about ESG. Our fundamental analysts consider ESG as part of their process, right? They know the companies the best. They know the sector the best. They know the investors that are interested in that space. So they can really add in that lens better than a group that just sits to the side and provides unique factors in the ESG space only.
Yeah, it certainly seems that you really do need that holistic approach within each of these sectors to really be able to make the sort of impact, especially for investors. A big thank you there to John Miller, TD Cowen Managing Director. Thank you for joining us this morning. All right, sandwich chain Subway is out with a debt plan as it aims to get its asking price of more than $10 billion. That's according to Reuters. Yahoo Finance says Brooke DePalma is here with the details. Hey, Brooke.
Good morning, Rochelle. That's right. Bankers behind the Subway sale are looking to make the case that this is a prime opportunity for private equity firms to strike a deal and buy an iconic sandwich chain. That, according to Reuters exclusive, JPMorgan, who is advising the company and conducting the sales process, is hoping a $5 billion debt financing package will show potential buyers a way that they can finance a deal, even in times of turbulence. Now, that package is based on a mix of loans and bonds, and its size is equivalent to 6.75 times Subway's 12 months EBITDA of about $750 million. Now, this comes as we saw the lowest volume of leverage buyout loan volume in Q4 of 2020. That's the lowest since the first quarter of 2010. Now, this also comes as the Fed is set to announce its latest policy decision. On Wednesday afternoon, investors expect the central bank will raise interest rates by another 25 basis points. Now, at a recent conference, CEO John Chidsey said the process to be sold is well underway and aims to have a deal signed sometime by the end of May or the beginning of June. Now, he also said that this is actually a perfect time to sell because there are a few other deals to be had and private equity firms are sitting on capital. Now, important to note here, Yahoo Finance did reach out for comment on this report and Subway declined to comment. Rochelle?
And Brooke, the Subway chain has been gearing up for this sale. It reported sales results last week and announced a franchise agreement. Break down for us what a firm could be getting for itself with this deal.
Right. Well, Subway certainly in growth mode here, looking to really get some interest from private equity firms and certainly sort of rum up that sandwich sale, so to say. So in Q1, Subway saw its 9th consecutive quarter of sales growth. Now, Subway also saw the highest average weekly unit volume since 2010 in Q1. Now, as you can see here, global sales were up more than 12%. Digital global sales up more than 11%. But taking a closer look here in North America, where it all began, sales were up 11.7%. Now, digital sales here, look at that number, up more than 21%. So Subway looking to keep up with the likes of other sandwich brands that are publicly traded. But this also comes as the company did announce plans in mid-April to consolidate franchise ownership, looking really to have 5 multi-unit owner agreements across Texas, Arizona, and the Mid-Atlantic. They also opened 145 new restaurants in Q1 of 2023. That brings total restaurants to nearly 37,000 restaurants in 100 countries. CEO really emphasizing that there's large potential for international growth here. But one could say that this growth plan, this really robust way to bulk up their sandwich, essentially, this offering here, started back in July of 2021 when they announced the Eat Fresh, Refresh branding, of course, after that tuna controversy came out. And then since then, they've ramped up their marketing efforts. They've had the likes of Rob Gronkowski, they've had Stephen Curry, all come in to really emphasize just how Subway relates to the everyday person.
It's true, and it certainly was a value play, you know, at a time when people are bracing for recession as well. Well, we'll have to see who bites. Our very own Brooke De Palma, thank you so much. All right, coming up, getting caught in the crossfire. SoFi's personal lending business delivers the goods, but shares yo-yo. It may be a different bank to SVB and First Republic, but is there any read across? We'll discuss next. Let's do a quick check of the markets sponsored by Flex Shares. We're seeing a mixed picture now with some of that selling action slowing down for the Dow, as we see that now just up about 54 points. The S&P 500 also up about 1.6 points, just barely there, eking out some gains. The Nasdaq there turning negative, down about 1/3%. And in terms of the sector action in the S&P, we're seeing energy and consumer discretionary, the laggards there. Right, SoFi reported quarterly results before the bell. The online loan lender reported a smaller loss than analysts expected and said it still expects to be profitable this year, even amid the wider contagion from bank failures. Joining us in studio to discuss is Anthony Noto, SoFi CEO. Thank you so much for joining us on Yahoo Finance today. So first, I want to get your big takeaways here. I mean, when we look at especially the personal loan origination volumes shooting up 46% in the quarter, how was SoFi able to insulate itself better than some other banks?
Yeah, this is our 8th consecutive record revenue quarter in a row. And that's a reflection of the diversity of our business, not being overly dependent on any one product or service. Because we're a digital one-stop shop, we're helping people get their money right across a variety of different products. And in different environments, such as high interest rate and a slowing economy, we have products that can do well. Similarly, in a lower rate environment and a faster economy, we have other products. And so over the last 2 years, we've been able to operate in that wide spectrum of economic backdrops to deliver consistent results. In fact, record results 8 quarters in a row. So it reflects not just our lending products, but also our technology platform segment and our financial services segment, which is less dependent on credit. So within that segment, we have checking and savings, we have brokerage, we have insurance, we also have partnerships that generate lead revenue. So the inherent diversification is what's allowing us to operate in both of these environments and continue to have a very favorable outlook in terms of overall growth of the company.
And as a lot of us are sort of passing through wondering where a lot of these deposits went in the fallout from SVB and Signature Bank. I mean, looking at your deposits, they're increasing by $2.7 billion sequentially, another record there. How much do you think SoFi benefited from what we saw with the collapse of those banks?
We would have had a really strong quarter for deposits, even without the issues that took place. We were well on our way to over $2.3 billion of deposits before the events unfolded in April 9th, 10th time period, similar to what we've seen in the prior quarters. So I'd say a portion of what is reported today is likely due to people looking for safer, more well-trusted banks and banking relationships. So without a doubt, we are one of the more trusted brands. Our brand awareness continues to grow and continue to become a household brand name. In addition to the fact that we're a national bank license company that can offer $250,000 directly at SoFi, but an additional $2 million of FDIC insurance through a partnership. So that attracted some dollars, but we would have been well over $2 billion had nothing happened in April, and we see similar trends continuing.
And what are some of the questions that clients have for you as they do wonder about contagion?
People want to understand what's happening with student loan refinancing business. We grew that quite meaningfully from about $400 million of volume in Q4 to over $500 million of volume in Q1. We stole significant market share. That reflects our ability to provide a better interest rate on loans than our competitors. And so we're seeing growth there despite the fact that the student loan moratorium is still in place. Our brokerage business is contributing and continuing to scale very nicely, as well as our credit card. Our technology platform had strong double-digit growth, and we've started to focus on bigger, larger customers that are more durable, and so that's also contributing to the growth. And so they just want to make sure that we have things driving the business beyond just credit.
And how are you prioritizing some of these investments in technology, since that is such a critical part of the business?
Without technology, SoFi wouldn't exist. So it's a core part of everything that we do. It's a large percentage of our investments each quarter. It's a large percentage of our employees. Our ability to continue to drive innovation, to continue to become a trusted household brand name, to continue to drive the selection we have across all of our products is a direct result of our technology investment. We're helping members buy better with our checking and savings account, as well as our credit card. We're helping them save better with 4.2% interest on savings and over 1% on checking. We're helping them invest better with SoFi Invest, where you can buy single stocks without commissions, fractional shares, SoFi robo accounts, SoFi ETFs, as well as cryptocurrency. In addition to that, you can buy home, auto, and life insurance. And of course, you can buy a home using our mortgage product or refinance your mortgage through our mortgage product. So pretty wide diversification of products and services depending on your needs.
And as we also have a lot of non-banks, expanding their reach in this space, obviously Apple and others as well, how does SoFi position itself to really stay ahead of the game here, especially when it comes to personal lending, something that we might see some of these big tech companies step into as well?
Sure. Because we have such a broad portfolio of products in our product suite, we can be more competitive on attractive rates, better services, better selection than others because we have more economics and lifetime value than our key competitors or new entrants to the marketplace. And so we try to differentiate each product on fast selection, content, and convenience. And then uniquely, we want our products to work better when they're used together. Other companies are singly focused on one product or two products, so they can't leverage that better together strategy the way that we can, and it's a key differentiator.
I do appreciate you joining us this morning on Yahoo Finance. Anthony Noto, SoFi CEO, thank you for your time. All right, coming up, a stark change of tone. Twitter's former CEO criticizing the man he once labeled the, quote, singular solution to take over the company. Find out what he said next. Former Twitter CEO Jack Dorsey is changing his tune on Elon Musk, writing in a post on social media competitor Blue Sky that it all went south for Twitter once Musk took the helm. Yahoo Finance's Dan Howley joins us now with the details. Quite the turnaround here, Dan.
Yeah, that's right, Rochelle. This basically comes after, Jack Dorsey was gushing over Elon Musk taking over Twitter. He, as you previously said, called him the singular solution to the platform's problems. And he, basically full-throated endorsed him as CEO. Now, after he's been CEO for a while, he's cut jobs there dramatically, made some serious changes to the platform, trying to make it more of a subscription-based model rather than an advertiser-based model, driven away advertisers, made different decisions as far as content moderation. Dorsey seems to be backtracking on those statements. He was asked if Musk was the right leader for the company on his competing platform, Blue Sky, and he basically said no. He said he thinks that he really shouldn't have gone forward with the sale. He thinks he should have just backed out. He thinks the board shouldn't have forced Musk to buy. Remember, he had said that he wanted to back out, but then Twitter said, no, we're going to take you to court because you had agreed to this sale. And so before they actually had that trial, Musk and the board went into an agreement for that $44 billion sale. But Dorsey really saying that, as he said, it all went south once Musk took over. And look, this is a platform that continues to struggle. Advertisers had left because they weren't sure of what Musk was going to do. There's questions as to whether or not the new blue check marks are going to work well. Obviously, he stripped the vast majority of people of the blue check marks unless you subscribe to Twitter for that fee, and then you can get your blue check mark. But he did give them to some celebrities who seemingly didn't ask for it. Stephen King among them, LeBron James. So, it's still really a very much in flux situation as to whether or not Twitter will ever be able to become what it once was or what Elon Musk, I guess, hopes it will be. But meanwhile, as I said, there's competitors like Dorsey's Blue Sky that are starting to come up. And, if you look at Blue Sky, it pretty much is Twitter, but just open source. So, we'll have to see where that kind of leads the two figures, if their friendship is now tarnished or they'll continue to work together in the future.
And just very quickly, Dan, do we think Twitter would have survived if it stayed public?
That's a good question. Musk says that he needed to fire or lay off all of these people, needed to make these drastic cuts because the company was heading towards bankruptcy. It never really was a well-run business. I mean, you had Dorsey running it while running Square at the same time. There was questions as to whether he should have been doing that. Dual CEO, one of a struggling company, one of an up-and-coming company. It seems as though the company was going to head in this direction regardless. It's just the way that now they don't have that extra revenue coming in from advertisers, or it's lower than it was, compounded by the fact that obviously the digital ad market is still struggling. We see Meta and Google doing relatively well, but Snap struggling heavily. So you would imagine that Twitter would probably fall on the side of Snap, since it's not as large or as important as a social network to most people. If you're in journalism, you're looking for celebrities, it really is important. But outside of that, I don't know very many people who use Twitter regularly.
That's true. I mean, it continues to unfold. We do thank you for that update, Dan Howley, there for us. Well, let's do a quick check of the markets here, sponsored by Flex Shares. We see there's still a mixed picture here. The Dow still under pressure, up though about 50 points on the day. The S&P also up slightly, about almost 3 points on the day. The Nasdaq being weighed down there, as we see Nvidia, though, at least helping keep it up a little bit, though. Nvidia up about 3.22% there. But you're seeing big tech, Amazon, Tesla, Apple, Microsoft, Google, all under pressure at the moment. Right, that's it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern tomorrow. See you then.